Retirement is a period in life where one ceases to work for money, or it's the time in life where you leave the active workforce. In Ghana, the official retirement age is 60 years. However, one may opt for early retirement, which is from age 55 to age 59. Some people retire unexpectedly due to certain unforeseen life events, for example, medical incapacitation or job loss. Whatever the reason may be, we all need to have passive income during retirement. When we say passive income, what we basically mean is that having to earn income without working. It's important to note that retirement is not a death sentence. Rather, it's the time of our life where we pursue unfinished life goals. To enjoy a comfortable retirement, workers need to put in place a deliberate plan rather than leave their retirement to chance.
Do you know that your retirement will come much sooner than you think? Retirement is a crucial stage in life that.
Hello and good morning to all of you once again. You are welcome to the 2021 Pension Strategy Conference brought to you by Axis Pension Trust, your reliable partner in pensions. Also in association with the CFA Society Ghana. My name is Jeff Asmeni and I'll be your MC for the second day as well. Ladies and gentlemen, yesterday, for those of you who joined us, we had an exciting time at our conference discussion. We had as many as over 300 participants actively participating in yesterday's webinar. And even today promises to be a more exciting one. Yesterday, we had a conversation on mortgage securitization. We had a conversation with regards to real estate, and we also had conversation on the economy. Today, we'd like to bring all of them together to have a much bigger and broader conversation as to how we can champion all of these pension funds that we are responsible for. Of course, this strategy conference is key, identified and targeted at trustees as well as fund managers of pensions and all those who are stakeholders in the pension space. Again, you're welcome to the second day of the Pension Strategy Conference brought to you by Axis Pension Trust and CFA Society Ghana. We'd like to start our conversation this morning with an opening prayer as usual. And so to help us do this, I'll call on our colleague, Mr. Emmanuel Intre, to begin with us an opening prayer. Hello, Emmanuel.
Hi, Jeff. Good morning.
Please pray with us.
Very well, thank you. Shall we please close our eyes and have a word of prayer? Father, we thank you, we bless you for the gift of life. We thank you for giving us another opportunity to meet once more. We pray that let your presence be with us to enable us to have a fruitful and successful conference, that at the end of it all, we'll have every cause to give you praise and thanks. We thank you for an answered prayer. In Jesus' name, amen.
Amen. Thank you very much, Emmanuel. And now that we have prayed, we are certain that we would have a successful conference. Ladies and gentlemen, we would start a conference with a welcome remarks. And to give us a welcome remarks is a man who himself has played a key role in the development of the capital market here in Ghana. He is a member of the CFA Institute. He is currently the president of the Ghana Securities Industry Association, an umbrella body for capital market operators here in Ghana. And he is currently the managing director for Stanbic Investment Management Services, Ghana. I'm happy to introduce to you Mr. Alex Asiedu. Hello, Alex.
Hi, Jeff. Good morning. Thank you for the introduction. Thank you. Good for you to welcome me. I'm grateful. Well, good morning to everybody, and it's good to be here. I'll just share a few remarks. A few months ago, and I work for a firm called Stanbic Investment Management Services. A few of our fund managers called me aside and said they were interested in this new asset that they wanted us to buy. And I wouldn't mention the name for obvious reasons, but it turned out to be very interesting. It turned out to be something for educational projects, but more importantly, it turned out to be a government instrument or a quasi-government instrument. And I was wondering why they would be this bullish on yet another government issue. And the reason is that pension institutional funds like us are flush with cash, and at times we don't know where to deploy the cash. So that's what it was. We didn't do it. Another story, and then we will connect the dots. I read about a young man who graduated from one of our local universities, and he started turning coconut husks into fuel that people can use instead of charcoal. And I've tried it, and it's actually very well packaged, and it's very effective. And I'm sure you've not heard of a young man, and I'm sure that if he doesn't have all the boxes ticked, sooner than later, his business will collapse because he won't have enough financing. So that's the second story. The first one is about our pension money, our institutional managers looking to deploy cash in a government asset. And the second one is about this young man who set this up. And then we need to connect the dots. We need a platform, or we need a space that will enable us to package things like to package products like the young man is packaging, like the young man is producing, call them alternative assets so that we can use the funds that institutional fund managers have and fund them. That way you are creating impact across your communities. That way you're creating avenues for fund managers to deploy cash in areas that really need it, instead of the stuff that we've all been doing already. Available statistics suggest that, and I'm using proxy data from a couple of the large fund managers in the country, 70 to 80% of our funds are in government instruments or quasi-government instruments, meaning we are crowding out the private sector. And so it's a real problem. Yesterday, we spoke about, the meeting was about real estate and alternative assets, mortgage-backed securities, etc., and how institutional funds can pump their funds in there. Today, I hope that we will have a clearer discussion on ways that we can do investments, maybe private equity, etc., on ways that will enable us to connect institutional funds, the supply of institutional funds, with entities, investees that need these funds in the alternative space in ways that will create impact for the investor in terms of return, impact for the investee in terms of value, and impact for our communities instead in terms of value too. Welcome again today, and I hope that our discussions will lead us to clearer, actionable goals that will get us where we want to get to. Thank you all.
Thank you very much, Alex. Thank you for the very sharp remarks, and certainly we would have a wonderful time today. Ladies and gentlemen, we had a lot of questions that we could not respond to yesterday. We did promise that today we will make time to respond to all such questions. And so before we begin our conversation, I'd like you to take down the notes that you have, even from yesterday and the presentations that we'll be having today, in order that you're able to send in your questions early enough for our panelists and even our presenters from yesterday to respond to your questions. Our first presentation will be on Economic Outlook Report. The presenter is the investment strategist here at Axis Pension Trust. He has over a decade experience in financial and capital markets. He holds a CFA and a CIMP designation and is passionate about the democratization of finance as a catalyst for reducing income inequality, especially among vulnerable societies like what we find ourselves in now. Ladies and gentlemen, to help us with this presentation is the Chief Strategist, Investment Strategist here at Axis, Mr. Carl Okra. Hello, Carl.
Hello, Jeff. Good morning, and thank you for that kind introduction.
It's good to have you, Carl. You can begin your presentation now.
Sure. If you permit me, I'll just attempt to share my screen in the next few seconds. Jeff, can you please see my screen?
Yes, Carl, we can see it now.
Okay. Good morning once again, and good morning to everyone who's made the time to be with us here today. So at Axis, at the end of every year, we undertake an economic survey. And the aim of the survey is to gather insights from market participants on their views on the macroeconomic and capital market outlook. And that predominantly is the aim of these surveys. Now, 2020 was an interesting year for obvious reasons. It will be remembered in history as one of those years where there was an unexpected event that came with such adverse consequences. Governments all over the world had to revise as the year unfolded. Multilateral organizations such as the African Development Bank and the IMF also had to revise their forecast as the year unfolded. Households also had to revise their household expenditures and budgets as the year unfolded. Such was the scale of the problem and the challenges we faced in 2020. And for us, the lesson in that was that, and particularly in an industry where we are prevalent with economic forecast and expectations, is that we ought to receive confident pronouncements and predictions about the future with some level of skepticism, because as humans, there's only so much we can see into the future. And so we have to be humble enough and not make such pronouncements, believing that, that will certainly occur. Now, the challenging truth is that 2020 is not going to be the last year where an adverse event occurs. There's been many such events in society. But the good news is that society always manages to regroup and bounce back stronger. And from a market perspective, markets after initial bouts of volatility also bounce back, and in more cases than not, head north as well. So we realize that what is more critical is being invested in the market over a long period of time, given that markets do recover and society does recover. But it's more challenging than it is. It is extremely difficult to see your value of your portfolio decline and still hold on with the hope that it will eventually rebound. And what we've come to realize is that to be able to stay invested and have the benefit of time on your side, it is extremely important to have a strategic long-term asset allocation made up of diverse assets, whilst being nimble enough to take tactical advantages of dislocation in market when such events occur. And so this year, we've decided that we would wrap the economic survey in the context of where it fits into the economic cycle and how potentially investors can take advantage of that cycle. So I'll begin with the GDP growth outlook. Now, 2020, Ghana recorded a technical recession. And based on our interaction with market participants, the range of predictions from the survey was between a GDP of 1 and 5.5%. And our respondents came in with an average growth rate target of about 4.1%. And that somehow is in line with Moody's forecast of 4%. Other organizations have come out to have their own forecast for the economy as well. The EIU predicts, that's the Economic Intelligence Unit, predicts a growth of 1.9, whilst the World Bank predicts 1.4, and our government had a growth of 4.7 and until recently revised it to 5.7%. The reasons that contribute to the positive growth outlook include vaccine-related optimism, in the sense that once vaccine kicks in, sectors in the economy would recover and business would resume some semblance of normality. Other factors that contribute to tailwinds include improving trade relations with the international community among major market players, given that in the past couple of years, global growth has been put on the back burner because of geopolitical reasons as well, and also due to the virus. In addition, the implementation of the AFTA agreement, which is bound to put Africa on a different pedestal because of the enormous market opportunities, creates an opportunity for strong growth, especially if Ghana is able to tap into the benefits of such an agreement. And finally, on the positive side, is the fact that both fiscal and monetary authorities still have a stance of supporting the economy through policies such as government spend, as well as management of interest rates from the central bank side. However, headwinds or risks still persist in the economy. And I guess that is why the range is as wide as from 1 to 5.5%. And key among those is also, COVID-related matters and its consequential prolonged delay in economic recovery. In addition, we have realized that a lot of governments, in Ghana included, had to stretch their debt levels or their fiscal position in response to the virus. Now, hitherto, Ghana already had, a somewhat challenging debt profile, and this was only compounded by the events of 2020 carrying into 2021, and that presents, some level of risk to the economy. Also, in there is the fact that some commodity price shocks can impact our economy, given the fact that we are predominantly, a commodity-driven country. But for us, how we look at this is, 2020, Ghana grew way below potential. If you believe that long-term trend is about anywhere between 6 to 7%. Now, what the forecast tells us is that, it's an opportunity to grow, and the expectation is that we will grow and narrow the output gap. And the question is, to what extent that gap narrow, and what implication does it have on security prices? And the next factor we considered through the survey was government's fiscal position, which has become, a bane to the economy, as in is one of the most challenging factors that government is facing at the moment. And our respondents, 82% of them believe that government will miss its deficit targets for 2021 at minus 8.13. And key among those points are the fact that economic activity will continue to be constrained due to the effects of the virus, and that would limit government's ability to mobilize revenue as much as it would want. And also, as government continues to have a social contract with its citizens, pandemic-induced expenditures cannot be avoided, and as such, that would prevent the level of fiscal consolidation that government aspires to have. We still continue to be grappled with debt issues, legacy debt issues from various sectors, and with rumors of pending judgment that's also on the horizon. That also creates some risk towards attaining fiscal consolidation, especially to the extent that the economy would need, and to the extent that government desires. Also, government will continue its fiscal support, all in a bid to help the economy rebound, especially if we take the fact that we are so much below trend, and the aim is to reduce that output gap. On the next set of items that we discussed or we surveyed in relation to yields, which have a direct consequence on many of the policies and many of the expectations of security prices. First was the policy rate. Our respondents believe that the central bank would assume or continue to assume an accommodative stance because of its desire to see yields reduced to some level, which will also help government finance its debt stock. However, there's risk to that happening. Key among that is government's debt financing requirements. The bigger it gets, then the more challenging it is for government to reduce its rates. And also, what happens to the depreciation of the currency is key to the central bank's ability to reduce rates, to the extent that it does provide some stimulus into the economy. Another factor that was surveyed was expectation towards inflation, and many of the surveyed participants believe that inflation will continue to remain well anchored within expectation, especially given the policies that have been rolled out. However, there's some upside risk to the inflation target, especially if you look at what potentially could happen to commodity prices. Now that the forecast is for crude, for example, to hit somewhere between 75 and end the year potentially 100, what does that present? What in terms of risk to the inflation outlook for the country? So despite the fact that the expectation is for it to remain well anchored, there's still some upside risk, especially on the commodity side. On short-term rates, as we were exposed to yesterday, majority of respondents believe that short-term rates will remain neutral, and bearing any unforeseen surprises because of a debt financing requirement that the government faces, and also in a bid to balance between the fiscal and keeping the currency in check. The pace of reduction would be controlled somewhat in order to keep CD assets still attractive. On a longer term rate perspective, the expectation is for that long rates to also somehow be range bound and trade between where they are currently at this in these times. However, risk also remain to that outlook, and the success of government managing long-term rates to the ability that it so desires will also be a function of, how open capital markets are to government securities. And in that, government success in raising or tapping into capital market would greatly influence how long-term rates behave during the course of the year. And finally, on currency, I mean, the country has, for the past 10 years, 15 years, on an annualized basis, the currency has lost close to 12 to 14% of its value against the USD. And so if, there's one call anyone can make with such confidence is the continual or perennial depreciation of the local currency. And this predominantly is due to the structure of the Ghanaian economy. And however, the pace of depreciation matters. Last year was a healthy level, and despite the fact that expectation is for the trend of depreciation to continue, the hope is that that performance would still persist this year, especially if government is able to tap into the international financial markets to raise the anticipated Eurobond that it seeks. Taking into cognizance that majority of our reserves are based also on portfolio inflows, this will be key in determining how the currency unfolds. However, the expectation is for it to perform as well as it did relatively to last year. Now, the real sector also, is extremely important, and we've seen a rebound from the lows of March last year, with consumer confidence picking up as well as business confidence. So in summary, GDP is below trend, but the output gap is closing because expectations for GDP to rise. Inflation will remain well anchored within government's targets. The policy rates, bearing any unforeseen surprises or any surprises, is to be accommodative, and the real sector, recovering. So what does that mean for positioning of portfolio plays or asset allocation? Our experts believe that through the survey, it's a good time to build into equities, given that we are now recovering from such a low base and with valuations at such low levels. And so the equity play is to build some exposure in there. On the fixed income front, and given the shape of the yield curve, our experts believe that it's still prudent to play the duration game and then have some exposure on the longer end, middle to longer end of the curve because of income potentials, especially to a portfolio that needs that much income. From a treasury bill perspective, and especially relative to cash, our experts believe that hold more treasuries compared to cash because of especially where we are in the cycle. And if you can, gain some exposure to Eurobond because of the foreign currency element that you gain from investing in a Eurobond. On the corporate bonds perspective, our experts believe that you have to remain neutral simply because there's still uncertainties in the corporate space. Credit is not yet where we expect it to be. But if you have to gain exposure into corporate bond, be very selective about the securities that you're gaining access to. And also because there's quite frankly a dearth of securities of corporate instruments on the market. From a bank fixed deposit perspective, reduce your exposure if you can, because banks are washed for liquidity, especially because of the restructuring of the financing sector. And so from an individual or retail perspective, you're likely to get anything above inflation on a bank FD. Local governments, because of the way they're structured, they offer such healthy risk return, and so enhance your exposure to local governments if you can. But more importantly, and finally, gain some access to alternative instruments such as commodities if you can, simply because of the potential of the risk in the economy, and also gain some hard currency, foreign currency exposure if you can, through well thought out vehicles that can mitigate any risk on the horizon. So Jeff, I'll end it there, but let me just add that a final copy is available on the website for thank you.
Sure, Carl, thank you very much for your presentation. We are very grateful. What we are going to do in order that we can manage time for today, because we intend to take a lot more questions at the tail end of our conference today. So we are going to try as much as possible to move some of the questions to the tail end, a bit to the tail end towards the panel discussion, so that we can have you also take some of these questions.
Sure,
I hope that is fine for you.
Sure, no, thank you.
Okay. But maybe just one, Carl, maybe before you go, maybe just one comment. I noticed there's a question from Kwame Odame. I think it's a suggestion, I'm not too sure. So I'm going to read it to you, and if you have any comments you can make on it. It says that, just as a point of clarification, Nassim Taleb mentioned last year that the knockdown effect of the COVID-19 were fairly predictable and not considered a black swan event. He says that a 10-year average growth of 6% roughly translates to the Ghanaian economy doubling every 12 years. And maybe the question here is that, what implication does this have for pension funds or for the pension sector as some citizens engage in more economic activities?
Okay, the first part, the comment is well noted. We can always have this discussion offline. And on the second part, and just to keep it short in the interest of time, as long as output is increased, we believe that then the general macro conditions are well placed for Ghana to be where we want it to be in terms of production. So if the growth is through enhanced output and not just from price levels, then then it's good for the economy.
Okay. All right, Carl, thank you very much. And like I said, any questions that we'll be receiving from now, we'll push it up to later on so you can respond to them as well.
Absolutely.
Okay, thank you very much, Carl Okran. He is the investment strategist here at Access Pension Trust. Ladies and gentlemen, as I keep saying, you can kindly take down notes in order that you can put your questions up for answers by the presenters. During at the appropriate time, we'll call them out to mention to them what their response is to your questions. We'd like to move to the next presentation. And the next presentation is actually on a topic of private equity and private equity debt opportunities and private debt opportunities in Ghana. The good thing about this topic is that we'll have two presenters doing this presentation or speaking to this topic. The first presenter, as we will take it, is currently the founder and CEO of Oasis Capital Ghana Limited. It's a private equity firm, management firm based here in Ghana and also in Cote d'Ivoire that focuses on SMEs here in West Africa. Our presenter has more than 20 years working experience in the investment market space, investment banking space. Prior to his current work at Oasis Capital in 2010, he was the country director for Growfend Ghana Limited, a Pan-African SME development and finance company that has operations in 8 African countries. He also used to work with Fidelity Capital Partners Limited, a private equity firm based in Ghana. Obviously, he is very well known in the circles of private equity, And so he sits on many boards of SMEs here in Ghana, providing insight in governance as well to these SMEs. I'm happy to introduce to you, ladies and gentlemen, the CEO of Oasis Capital, Mr. Matthew Adjei. Hello, Matthew.
Hi, thank you very much, and thank you for your kind introduction. I think it's a pleasure to be invited to be a participant of this conference, and I think it's a laudable idea. We should keep it going so we can share ideas and thoughts and see how we move this country forward. I've structured my presentation in just about 7 key sectors, and I will give a brief introduction. I will speak about the fund structure. I will speak about investment cycle, return configuration, the general partners themselves, which in Ghana we use a lot more limited liability structure. Private equity value add risk, because as pension funds, we will be asking, are these not too risky investment? And then we will highlight the opportunities that some of us see within the sector. And then I also close off with some case study from Oasis Capital by reason of our 10 to 11-year operations within the economy. So we can take away something. The first thing is just to give a primary definition of private equity and private debt. I think it is just a simple statement. I always say that it's just investment in unquoted assets, usually by fund managers that aggregate funds from institutional investors, and also with respect to in a form of equity. And then for private debt, issuing debt instruments, which is also managed under similar structure by that. But just to give us a certain perspective, I think all of us know that by reason of Ghana law, Banking Act, lending actually have to be done under the certificate of a license. So with the introduction of few debt on the private side, Security and Exchange Commission saw the need to regulate it so that we do not necessarily have to go through central bank licensing as a bank and or a financial institution to be able to issue private debt. So that to give exact color. So to as of even date, private debt, just same as private equity, are both regulated by Security and Exchange Commission of Ghana. I also want to take the opportunity to highlight that all over the world, economic growth and innovation have been driven by private equity capital. So there has been global giants like Google, Facebook, and also in the local strand, we have also seen quite a number of private businesses that have been spearheaded by private equity capital. Indeed, our first attempt at private equity was way back in 1994, when the first private equity firm, Ghana Venture Capital Company, was set up by CDC and a few other development finance institutions. So we have had that history over the period up to today. But during that time, our private equity practice was unregulated, and in fact, before the VCTF Act was passed in 2004, to do private equity based on the Bank of Ghana list of institutions, we needed a license from the central bank to be able to do so. However, through the efforts of some lobbying and support from the Minister of Finance then, Kojoba Redo, the late Kojoba Redo, where we passed the act which sought to regulate the environment. Subsequently, the VCTF Act itself has been amended. I think the first VCTF Act was very generous, offered sweeping incentive for the sector. So there was tax deductibility for investment that were made. Venture capital funds and private equity firms were non-taxable entities and did not even have tax files at the GRA. But somewhere in 2014, I think as a result of government seeking to rake in more revenue, some amendments were made, and that made the venture capital and private equity firms taxable entities. But subsequently, there have been a few more discussions which have lightened the tax. But it's just a nuisance tax because to date, the private equity firms and VC firms actually attract a 1% tax rate, which in my view is just a nuisance tax because the cost of even collecting that revenue is way more than the revenue that it will be generating. As I indicated, we've seen that practice over the period, and then also the Private Pension Funds Act was passed, and subsequent to that, through the regulation, some amendment have been made which allows a certain portion to be allocated to alternative assets, including real estate and private equity investments. To date, we can say that following the operationalization of that, we have received capital from some pension funds into the private equity space. My next slide is just giving us a dive into the typical structure that we do and use. You would find that globally, pension funds, endowment funds, development finance, institution insurance, i.e. institutions that have a very long-term capital are the ones that put capital to available into funds, either in the form of a fund of fund who intend to invest in private equity funds or directly in private equity funds. Sometimes these institutions would also make a direct investments, but the practice has been that in making direct investments, the pension fund will do that through the joint investment of private equity funds that they have already put in money. And the reason is simple. Private businesses that we invest in are opaque. They have asymmetric information. Pension funds are not structured to be more granular with their due diligence. And it is assumed that in practice, private equity fund managers are able to deep dive into the activities of these businesses so that we can minimize the risk and give you a pass-through as part of the additional benefit that you get by investing in private equity funds. I also want to highlight a few structures that we use. Typically, the institutional investors, including the high net worth and pension funds, are called the limited partners because globally people have been using a limited partnership act. But I will make a note here for Ghana that we have registered all our funds in Ghana. Conventionally, a lot of people go to Mauritius. They have a place they call the safe haven, which have the practice. But we have registered all our funds here. But Ghana law, I understand that is being amended and is being reviewed, does not work very well with the use of limited partnership because we do not have that limited partnership that limits the investor's risk. So we use a limited liability company, and therefore we design a structure that allows us to still be able to return capital without necessarily dissolving the company until after the 10-year cycle when we are ready to liquidate or haven't returned all the capital in that. Typically, we would make this, we will do this fundraising and by setting up a company which has a 10-year limited life. So most of the structures that we've used are limited life funds that we have created, which normally will have 10 years plus 1 plus 1. So that gives us a total of 12 years, the first 5 years of which to deploy the capital, and the latter part is to harvest the investment and return, unless there are extenuating factors that would require you to seek a 1-year extension for the investment period, and also for the same reason, extension for the liquidation of the fund. For you as pension funds, the key thing is that there is a period that the pension fund managers would invest, the fund managers themselves would invest and invite you through their private placement document. And after they set the clear goals and objectives for this investment, some of the funds could be either sector focused or geographical focus. So some funds can come and say, we invest only in fintech. Some will come and say, we do only real estate. And others would come and they are generalist fund because they invest in every sector that makes economic impact. And it is up to you to, and all of them would articulate their strategy very clearly in terms of where they are going to create value. They will show you their fee structure and the fund economics. But for limited partners, which the pension funds come under, some of the key things that you'll be looking at are how do you make this investment? Once you made the commitment, is the capital called immediately, or do we call it over a projected period? We have a slide that I will show you how that is called. And then how do we account for this in our books? And you have questions like, okay, how do we value the investments in the private equity? And how do I get my return? These are critical questions that you would usually be asking yourself. The first response to the first answer is that the capital is called over a projected period. You would also notice that in terms of showing it in your books, initial state is that you book investment at cost, and subsequent to that, after the period, you would base it on a market value. And now, thanks to IFRS, globally, we are all aligned in terms of casting investment at the true market value year on year. But for private equity practice, we do value our portfolio either semi-annually or quarterly. So for a period, I know that most of the pension funds report a monthly movement. So it means that if you invest in a fund that has a half-year valuation, you may have to repeat the same value until the next event date. The top corner would show you typical fee structure, which will normally be 2 to 3%. And in a larger economy where there are larger funds, the rate could even be a lower rate. Hurdle rate conventionally used to be below 6 and at a seal of 6, but now people have inched up and have a higher expectation. Hurdle rate follows a similar pattern, and typically the GP fund themselves also do make commitment into the fund, which historically used to be 1%, but now a lot more are increasing their investment to say that we are all aligned in that same. The table will show you how the calls are normally made and returned. Just to make a note for private debt, the return of capital will be earlier because you are getting a regular stream of cash right after the investment is issued. So if you look at this table, the fund manager is targeting about 2.2x money over the period with the return of capital running from the 5th year. I also want to highlight a few things in terms of what makes GP fund manager more attractive to you is the fact that they have very attractive strategy. The pension fund or the limited partners would look at for the experience level. Either it's a continuous fund or it's a new fund. And I want to make a note for this particular point for new funds, because if we are not careful, then we will begin to see experience. Because in our fundraising, we saw that somebody mentioned that, oh, the fund is a startup. To the extent that private equity funds are normally created as a limited life fund, please, pension funds, you will be investing in startup. So it is an SPV that is created and everybody makes the commitment. So as of the date of closing the fund, and it's a limited life fund. So once the close-end fund, so once the fund raising is closed, you don't have the opportunity to invest again unless there is somebody want to exit midstream, and that may bring a very rare opportunity for you. So what as limited partner you would be looking for is the combined experience of the people that are coming together. So by practice, I've spent close to 20 years in this particular space. So if I leave Oasis today and I get another partner or another person who has similar experience and we come together to create a fund, the fund we are creating is a startup, but we are no startups, right? So you focus on the experience of the fund managers and the people that are involved in doing that. One other thing that you need to also look at is the culture that they come up with and the senior level skill set. And also you have to look at historical deal sheet for the people that are coming together to come before you. And I needed to make this very carefully because Ghana is still growing economy. I know that the private equity space is still at a very nascent stage, and a lot of people have expressed interest, and a lot of young people are coming together to create funds so that we don't price them out and say that they are startups. So long as they can aggregate a lot of resources and come together, that will be a very important thing to look at. So evaluating the fund managers, evaluation is not only even at the stage of investing alone, but there is continual dialogue and interaction with the private equity funds, just to give you room to see what is going on. There's a regular reporting that we do. So once you set investment strategy and you set the parameters as a fund managers don't change them unless there are very telling situations, like in the particular case of the pandemic, like 2020, Oasis has had to review our investment strategy. But these are decisions that you would require the limited partners to endorse, because the pandemic hit very hard in certain sectors that we were investing and had planned to allocate a lot of assets. But for purposes of prudence, we have had to vary our strategy midstream. And these are normal things that any rational being would do. So that is quite important to note. You also have to ensure that these are people who have operational skills. So sometimes the best team may come from not just people that have just investment banking and corporate finance practice coming together, but people who have had real industry operational experience, teaming up with this category of people to do that. In terms of evaluation, you also have to look at compliance with the necessary laws and regulations within the economy, all of which are intended to help improve the quality of the fund managers in that regard. This section would also point a few things in terms of the approach. There are people who have a certain notional stage view and thinking that private equity guys come in and they are just coming to take over your business and run the show from the end users. The idea is that there are different methods, but in all, every private equity practice that is worth its salt must get a bit more deep into the business, especially at governance level, because our own experience and reviews suggest that one of the biggest risks, although I haven't put it directly in my risk analysis, is that entrepreneurs themselves, particularly in Ghana and in other jurisdictions, are themselves one of the largest causes of business failure. So they create the business and they help collapse those businesses as well. Right. So the governance is very important, the structure that you put in place, processes and procedure. So you need to get involved. You need to know what exactly that is doing, and you need to keep them disciplined to stay within focus as a way of minimizing the risk involved. This section talks about the general private equity risk. As you would say, operating in an economy, you would always be impacted by what will happen in the economy. 2020, when we looked at the overall performance, some portfolio companies did extremely well, but others were impacted heavily by what happened in the economy. So for instance, if you run a local curriculum-based school, the government of Ghana says you cannot operate. So naturally, you will not earn revenue and you will be impacted. But these are broader things that would happen. Other risks that you would also be looking for, particularly for you as pension fund, is to look at the illiquidity of the private equity. But that we would, I'll highlight in the later stage a few points for us to see how do we manage the liquidity of that particular sector, because we've also begun creating a practice and structure that allows us to create significantly liquid assets whilst focusing on equity. Obviously, equity expect to give you a higher return, but they appear to be less liquid. So you try to combine a dose of debt and equity that would allow you to still have significant liquidity, whilst at the same time keeping your eyes on the equity side. That would allow you to make a lot more return. But I've also put at the bottom what I call the key man risk, which is one of the things that you need to observe, that for every private equity practice, there are some critical persons. In some cases, it could be one person. So where it is, there are recommendations for them to diversify the team dynamics and the team mix in order for us to do that, to be able to manage that key man risk. I would mention that beyond the normal and the structure of the private equity fund, where you either put your investment in a private equity fund or a private debt structure, we need to also begin to see that there is an evolving trend for certain funds that would just be set up to focus on secondary transaction. Some will be for fund of fund and some will be for support services. So we do not have these in Ghana now, but I am convinced that a lot of people will start thinking about it and provide support, which themselves offer advantages for that as well. My last two points are focusing on Oasis themselves. Wawa experience, about 11 years of operation, having more than 70 million under management, operating in Ghana and Cote d'Ivoire, although our ambition is to look at a few more. Historically, we focus on health sector, housing, hospitality, financial services, education. We've completed 18 transactions, fully and partially exited from 8 of them, returned significant capital to our investors, and we are still growing on that. What has been our approach? Our approach has been focusing on businesses that have capacity for expansion. They have sales force, they are pricing well, we're looking at supply chain procurement. So these are areas where we add the value in order to be able to generate significant return for our investee. And I have just done slight and I have anonymized it slightly for some of the key things for you, that some investment that we did with in the educational sector, enrollment of 300 within a period of 6 years, they were 1,005 in 3 campuses, less than 300,000 cedi revenue. In 6 years, over 9 million cedi revenue. Similar one in real estate, as you can see on the screen. So indeed, the private equity or the alternative asset offers significant opportunity for return in that sector as well, because you know the story of a few private one beyond the failures. There has also been monumental failure for some private equity practice and investments, and we should not lose sight of that. But there are also the significant experience level to be able to invest in the sector and still make good return. Typically, you will be looking and keeping your eyes on financial return. So we also focus on the value matrix in the space of financial return. Some investors are looking at job creation, and some are looking at also not impacting harmfully our environment. And just to end, I would just align with what Alexis Edu hinted, that if you look at it, almost 70% of your money is already put to government paper. Beyond that level, 2/3 of all pensions are also going into SSNIT, except that now the private sector is growing at a very significant rate because SSNIT historically lost money from several fronts. So if you look at it, all the capital that is coming available are all finding the way back to government. So in that case, how do we grow and expand the economy? So we would encourage that in crafting and coming out with your investment strategy, you see that historically and in other jurisdictions, private equity has played a key role in building companies that have received private equity capital. In Ghana, Car Bank has received private equity before, Fidelity Bank has done so, EcoBank has done so, Vortic has done so, Nestle has done so. I think Aziz mentioned themselves have done so, Petra themselves have done so. So the private equity is a very live, successful, and well-tested model that has survived in terms of capital deployment. Indeed, the theory that government will always pay, government will pay, but sometimes the government will delay and can bring liquidity crisis to you. So let us focus on private equity also as an important class of assets. Thank you.
Thank you very much, Matthew. Thank you very much for your presentation. As I said, I intend to move most of the questions to the end of our program, but I'm going to mention maybe a few, about 3 or so of the questions for you, so that you can take them before we move on to the next one. The first question is from Martin, and Martin wants to find out what is the minimum investment period for private equity investment asset class, and should someone decide to exit ahead of the agreed period, what are the exit processes and are there any penalties?
Okay, thank you very much. The shortest tenure I have seen is 7 years, but averagely we use 10-year investment horizon. And it is an irrevocable commitment. So once you make it, you are locked in until that period. The good news is that with time, we begin to build structures that allows us to retain capital midstream until the 10th anniversary, where we expect to have retained the full capital. To exit the fund prior to the period, because it's a closed-end fund, you would only request the fund manager to go to market and find out, because the good news is that it's also a closed-end fund. So somebody wanted to invest and lost out during that window. So it is possible that when the fund manager goes back to the market on a best effort basis, and I have to make that statement, they may go there and be successful to do that. We've done that before, where I think in both funds, there have been incidents where we had somebody who was unable to proceed or wanted to exit. And we went back and we got some other people to take it. Sometimes even the other LPs would take it. So there is that possibility, but you should not invest to be expecting that you would come midstream to take the cash or to cancel that. It's not cancelable. You can only do that on a best effort basis. The reason why it's not cancelable is for two reasons. One is that you have legally committed the money, on the back of which the fund manager has also made commitment to other institutions. So if we allow you to cancel it, then you could expose the fund manager to some legal issues that may be costly. The first point is that are there consequences if you want to exit? Yeah. If you default, there are consequences. Usually we will charge you the target return by default, but not for canceling or for exiting. But exiting is feasible only by best effort from fund manager. Thank you.
Okay. I'm sorry, but I think there are a whole lot of questions, so I'll still try and push some of them to you to respond to now. The next question, we don't have a name to this, but it says that, what is the level of disclosure in private equity operations on deals in Ghana to ensure there's an enhancement price discovery in terms of cost and risk?
Okay, disclosure in Ghana is that it's a private fund. So we do not have a market where the deals are reported, but we work together closely and to our LPs. So if you are an investor, you can have access to that data, which tells you how all the deals were closed and the prices that were used within that space. But if you are not, it's not a publicly traded instrument. So you wouldn't find that as you do. However, there are two institutions. I think it is Ernst & Young and Riskura, based in South Africa, who have specialized in research and private equity. So they tend to have some anonymized and also more segmented data in terms of deals that are reported within the region. So they do have numbers for us in terms of review. Yeah.
Okay. And maybe the last set of questions for you is a double barrel question. So it's from Kwabna. He says that, how can we use private equity as strategic vehicles for accelerating growth in economically targeted sectors? And what 3 sectors do you consider critical for accelerating Ghana's economic growth?
Okay, I think in terms of economically targeted investment, private equity is probably the best practice, because it is the type of investment that you can create it. It's always created based on a strategy. So private equity is a strategy driven. So if you want to focus on a particular sector, you can set up sector funds. There are some funds that say that I want to promote entrepreneurial behavior of young people. So you can set up funds investing only in young people. Somebody can say that I would like to promote manufacturing and set up a fund that. So I think it's a very good tool for economically targeted investment. You had a second point.
Yes, what 3 sectors do you consider critical for acceleration?
Sure. In terms of sectors that I would recommend is that a sector that is driven more by innovation. So we're looking at fintech, technology based. And why? Because it is a sector that is moving the scale and of economic development in many jurisdictions. It's also a sector for future. It is a sector that has the dominance of the young and youthful population. So I would rather focus on that particular sector because its impact can be phenomenal if we are to look at it. But second sector I would also look at is that not just, it's also a sector that also has had significant failure as well. So as pension funds, we would also, if in a country like Ghana where infrastructure has to be built, I would also still recommend essential services, i.e. by investing in the housing subsector, in the mortgage instruments. For instance, unfortunately, I couldn't join yesterday, but many governments have always attempted to solve our housing problem in this country unsuccessfully. And it's still something that we are all thinking through to see how do we solve that. I think that if capital can be made available at a reasonable pricing to fund mortgages, that sector can also change events in the country. I mean, there are also scientific research that support the fact that if young people get houses, even their degree of criminal activity reduces. And you can tell the excitement when you got to your first home, right? So it is also a sector that we can look at more crucially. Another sector that I would recommend is that I think that manufacturing sector is still a sector that we need to look at. The reason is simple. This country, regrettably, has a reputation of depreciating its currency year on year for the past 20 years or even longer. And not just by 1% annually, but sometimes over 10%, double digit. And you would find that it is because, one, we have such phenomenal taste for imported items. And therefore, the dollars that we are sending away versus what we are gaining is quite disproportionate. And all those come together to impact the growth and development of our middle class. So if there is a policy, I would also recommend that particular sector as a key sector that we need to look at. Okay.
Thank you very much. Before you go, your last one, and I'm sure you'll be around till the end so that you can take the rest of them.
Sure.
Some of them I think you still need to respond to. Ajiman wants to know, how does Oasis as your company ensure entrepreneurs are disciplined and focused with regards to the investments you do for them?
We have to give them some slaps. I mean, I alluded to a point that my own experience point to the fact that entrepreneurs, and I mentioned this to my colleague when I was a country director for growth, and he came to Ghana and asked me, Matthew, what do you see as the biggest risk in Ghana, investing in Ghana? And I said that entrepreneurs. And he said, oh, then get up and go home because I sent you to Ghana to come and invest in entrepreneurs. And you are telling me that they are your biggest risk. Yeah, because of asymmetric information and the opacity of the private sector, because they are not required by law to report their data to anybody, right? You will not have all the information, but entrepreneurs that we have found and have grown in our economy had come as a result of people who seek to show that they are rich. I think Ghana has a culture when people begin to get few dollars, they want to let the public know they are rich instead of having the idea of building business. So there tend to be conflicting arguments between the business and the entrepreneurs and the way we have sought to do that. So we've not had a legal case with anybody. We've not gone to court with anybody, but it doesn't mean we have not had our fights with them. We have had our fight. I may appear as a very calm person to the public, but in dealing with me, make no mistake, it's not somebody that you would mix and go. Once we agree to, because I operate one principle that we don't want anything from you except what we have agreed to do. So just do what we have agreed to do. But so we focus more on governance. So even where we issue a debt instrument, we will try to be on the board. We try to get certain positive covenants, and it's a very difficult side where people say that you are just giving us a debt and you are asking us to pledge this. And we also have to educate even our lawyers, because most of the lawyers in the country are not familiar with this. And when you put up the clauses that we put in to give the warranties and all the other things that require and protect the investments, they tend to challenge it and go on the path of principles of equity and other things. They don't apply, because when the guy controls the business, he goes out there, he will like to do anything. And we need only the agreement to protect us. So the entrepreneurs' lie has been that you should have strong agreements, but the one that has worked most is that you need to build relationships so they become your partner. And if you demonstrate competence and willingness to work with them, they see you as a sounding board and a partner that they can work with. I think that works better than the one that is confrontational. So we're not confrontational, we work as a partner, but where we have to exert our right, we do.
Okay. Matthew, thank you very much. Like I indicated, there are still a lot of questions, but I think we'll push them a bit later on in the day so you can also take them as well. So to all of you who are sending your questions, to Amos, Emmanuel, to Yao, and all of you who are sending your questions, we would have Matthew respond to it at the appropriate time. Thank you very much, Matthew, for your time.
You're welcome. Sure.
Thank
you. Bye.
Great. So, ladies and gentlemen, like I indicated earlier, we have two presenters speaking on this topic of private equity and private debt opportunity in Ghana. Our next presenter is an investment director at Injaro Investment Advisors, where she leads the investment transactions and helps companies to perform better. Prior to Injaro, she was an engagement manager at Bruce & Company, a global management consulting firm where she has experience in advising top businesses, governments, and organizations in the United States, Middle East, as well as North Africa. She is focused on formulating and implementing strategic and operational improvements for clients in the agriculture, health, financial services, public and non-profit sectors. I'm happy to introduce to you Mirabel Moreau, Executive Director, Injaro Investment Advisors. Hello, Mirabel.
Hi, good morning. How are you?
Very well, thank you. How are you?
I'm doing really well.
Great. It's good to have you. So we'll have you also do your presentation, and if there are any questions, you have you answer them.
Great. So good morning, everyone. I believe Matthew has given you a very good broad overview of the PE sector and what we have to offer. So I'll change gears a little bit and essentially do more of a case study of Injaro as a GP to give you a lot more color about how private equity works. So Injaro Investment Advisors is an investment advisory firm. We are licensed by Ghana SEC. And as a group, we have various interests across sub-Saharan Africa. We are registered in Ghana and Mauritius, as well as the Ivory Coast. And broadly, we have experience in private capital, corporate finance, asset management, and management consulting. I'll briefly talk about private equity towards the end, and then about a specific offering that Injaro has for those of you who are interested in coming into the private equity space. I saw some of the questions come up in the box about how do people find PE opportunities to get into. So the Njaro story started in 2004 when the founders met at Wharton at the University of Pennsylvania. And fast forward till now, if you look at our journey, it's been very gradual. So Njaro itself was established in 2009 with an anchor investor that was Lundin Foundation. And that was shortly joined by AGRA, which is funded by the Bill and Melinda Gates Foundation. And then over time, we got some DFIs also join the LP pool. So we have DFIs including Proparco, FMO, CDC, as well as Soros Economic Development Fund. And it's very important to highlight this element in the development of a fund manager, because seeing more investors, especially investors who have been in the private equity space, support private equity fund managers is an indication of the trust they have in that team and the ability of that team to deliver in the private equity mandate. So the DFIs I mentioned, as well as Lundin and AGRA, were part of the first fund, umbrella fund that Njaro had, which was an agriculture fund. It was about $49 million in assets under management. And by then we had about 10 people that were in the team, and this was in 2014. When we fast forward to now, most recently, we're part of a fundraising with a diverse group of investors, including IFAD, which is under the UN umbrella, and AGRA, who was part of our investor pool from the first vehicle as well. And this second vehicle is Agribusiness Capital Fund. It's also agriculture. The target raise is 200 million euro. It's a blended finance vehicle that we're co-managing with another fund manager called Bamboo Capital. And the key takeaway from this slide is not just looking at fund managers who have had other private equity investments from other LPs, but the evolution that comes with being a fund manager that has had the time to develop a toolkit of processes and procedure about how to identify a company to invest in. What do you look at? How do you conduct the analysis? How do you structure a deal? How do you manage the negotiations with a particular entrepreneur? And then very importantly, how do you create value within the investment during the holding period until you exit and are able to realize the returns that are promised to the investor? And so in the private equity space, longevity matters because that creates the amount of time that you're getting a team to get together to create the necessary toolkit to be able to refine it over time and then deploy it in a way that makes sense for that particular market. So for Njaro in particular, our track record over the past 15 or so years has been noted by international organizations. In 2015, we were recognized in Impact Assets. And so that's a very reputable, independent, and searchable database of all impact fund managers in the world. And every year they select 50 fund managers to highlight, and we have been showcased in there. 5 of our companies were also in Companies to Inspire Africa, which was run by the London Stock Exchange in 2017. And then in 2018, one of our companies also received an award at the Private Equity Awards. So overall, over time, with the very first vehicle that I mentioned, which is the Njaro Agricultural Capital Fund, there are 12 investments overall, in various sectors, subsectors within agriculture. So animal feed, cashew processing, shea processing. And over time, we've deployed $31 million into these underlying companies. And in terms of revenue, cumulatively, we have been able to generate $107 million across these companies. And we have started returning capital to our investors as well. To date, we have returned almost $7 million to our investors. One of the key elements for this particular fund was impact. And this was one of the defining criteria that was put in place by the LPs. And the criteria that we have to keep tracking is the number of persons that are impacted by the fund. And we had a 1 million target in terms of the number of people that the fund had to impact during its lifetime. And currently we're at 3.78 million people. And this is a very important metric to track for an impact fund because it shows the multiplier effect that a private equity fund has in the community in which it's based, beyond just the employees or the suppliers that are in the companies that the fund directly invests into. And you could see a correlation in the next metric, which is the raw materials that have been sourced in the communities that the companies engage in, that you're seeing $67 million again cumulatively. And then for the exits that we have had so far with one of our companies in Burkina Faso, it was a TVPI of 1.3. So when you look at the map that's showing up there, the current fund was in a few countries in West Africa, and West Africa is quite a difficult terrain to operate into. So over time, we have learned a lot about the different countries, been able to build relationships with various partners in all those countries. And these are elements I'm highlighting to show what things that you will be looking at when you get a pitch deck from a fund manager that you're going to look at to assess whether or not you should invest in that particular fund manager. The second fund I had mentioned was the ABC Fund. So this is not just West African, it does have a presence in East Africa as well. And the vintage year was 2019. And as I mentioned earlier, the target is 200 million euro, but currently we have been able to raise about 59 million euro. And the focus of this fund is quite different from the first one, although they are both in the agriculture business space. This one is seeking really to fill the gap for companies, cooperatives, SMEs that are unable to raise working capital or shorter term loans as quickly as they need to. So agriculture is quite seasonal, and it's quite difficult for a lot of agricultural firms to raise money in time for their seasons. So the kind of instruments that are deployed here are as low as 200,000 euro to as high as 800,000 euro. Into these firms to enable them have the working capital to buy raw materials and process to meet the orders that they have. And already, although this fund is quite young, it's already impacted over 30,000 smallholder farmers. So now I'll just go over a few elements, some of which Matthew discussed during his presentation. So the matrix on the top left-hand side, the 2x2, we have liquidity and returns. And generally the space that a lot of professionals in the finance space here in Ghana understand are the listed assets. So the fixed income assets, the listed equity assets. And when you look at the liquidity, the fixed income is generally more liquid, very easy to turn around versus the listed equity. And on the extreme left-hand side are private equity assets and other alternatives. Now, the returns on the flip side tend to be higher for those particular assets, alternative assets classes, because of the how illiquid that they generally are. So again, when you look at the lifespan, as was highlighted before, the investment lifespan of a PSPV is long, is 10 to 12 years. But if you take a traditional treasury bill or listed equity, it can be days, it can be years, but it's generally a lot shorter than what you would expect for a PE asset. And for PE assets, there are no withdrawals, secondary sales are possible, but there are liquidity constraints that you have to be very mindful about. However, on the flip side, listed equities or fixed income instruments are very illiquid, and you can turn them around very, very fast. The upfront consideration for private equity is also quite different from the traditional assets. So there are going to be drawdowns over time to be able to participate into this particular asset class. However, when you're buying a traditional asset, typically the value you want, you just purchase that upfront. And finally, I think one of the key elements to also highlight is that for traditional assets, you're mostly marking time with the market. But in PE, you're not, because everything is based on an underlying business, which reflects a lot more in depth the macroeconomic indicators as well as the indicators within that particular sector that you have invested in. So the dynamics are quite different. And so that provides a very good diversification in the portfolio that you will have vis-a-vis having just the traditional assets. So if we look at traditional assets and then we compare them to private equity, why should you be going into private equity at all? So the first element that we'd like to highlight is the returns. As I mentioned before, the returns are generally higher in private equity than for the listed assets. And information is readily available in various jurisdictions. For Africa, we have the Association of the Venture Capital Firms in AFCA, and they publish reports periodically, and you could track that and see what the returns are for various periods in time, so that you could build your own business case internally about whether or not private equity makes sense in your diversification play for your asset. A key point to highlight is that the growth in the real economy is mirrored more in private equity than in listed assets. And we have seen this over and over again. And as I mentioned before, because of this difference with having the listed assets marking to market versus private equity, where you're looking at underlying economics within a particular business and its own internal capacity and growth prospects, then the diversification play is the second element, which really, really highlights private equity above what the traditional assets typically offer. So why does it work in general, given all these benefits that I have highlighted? So private equity really is not for the faint-hearted, in that you can't get up overnight and then set up a private equity firm and be able to raise money. it takes time. It takes having a team and developing the right mindsets, the right processes, the right procedures, building credibility in the markets to be able to raise funds and then deploy those funds. So when you look at the selection process, that investors will put money into a fund, and then the selection process of what happens before the funds get deployed to underlying companies, it's extremely rigorous. And I would say for us, when we look at our funnel and look at how many people come to us to look for funding versus who ultimately gets funding, it's less than 5%. The base is really big, but who ultimately gets the funding is restricted. And when you look at the management of private equity as well, it's not a passive business. It's a very activist activity. So beyond having positions on the board of these underlying companies, the fund managers are responsible for helping the companies realize the value that they have all identified to be able to create together. This means there is involvement at the management level. If there's a need within the company, there is involvement on the board, as I mentioned, and there could be a lot more that the fund manager can put into place. One of the key elements we've had as part of our 2 prior funds, which was very helpful to the underlying companies that we worked with, was a technical assistance facility. So this was funded separately from the main investment vehicle, and it allowed companies to be able to get additional funding in the form of grants that they had a cost share with, to be able to get experts in various areas, HR, strategy, certification, and they could use these technical assistance funds to help their operations and get to the target financials sooner rather than later. So initially, Matthew also mentioned several companies who have received PE here in Ghana: Voltic, Fidelity, Axis, our host, Accra Mall, and then a couple of our investees are highlighted. But the main point is that when you look at all the sectors within the economy, all of them lend themselves to private equity. So if you look at private equity firms which are set up and they are thematic, or they are focused only on particular sectors, and you run an inventory list against all of these themes or sectors, you will realize that most, if not all, sectors are covered within private sector. So you're going to find PE firms invested in financial services. You'll find them in real estate, healthcare, consumer goods, retail, technology, utilities, mining. So whatever sector you think about, most likely you're going to find a PE entity that will specialize in understanding those sectors, identifying pipeline in those sectors, and then investing in them as well. So I'll pause here and go into a case study, one of the firms that Njaro invested in, again, to give you additional color about how private equity works. So Agricare is a company, it's based in Kumasi, and it was established by Pfizer in 1968. And later on, Pfizer divested its ownership in Agricare to other banks when it decided to exit the poultry feed business. So Agricare makes poultry feed primarily and some other feed for pigs and other livestock, and then sells feed input materials and then some other animal health products. In terms of what their vision is, they want to become one of the key animal feed players in the sub-region over the next few years. So they've been in the market for a really long time. And by the time we met them around 2014, they had a spanking new factory with top-of-the-line Buehler equipment that could make about 10 metric tons of feed per hour, very high-quality feed. So in terms of the scenario, when we met them in 2014, their sales were falling. They had a spanking new plant. It wasn't functioning. Part of why it wasn't functioning was because they didn't have working capital. They had spent a lot of their IGF and some of the investment capital they had raised in the past to acquire the equipment, and they didn't have enough money to run. So they were running on a just-in-time basis where a customer would place an order and make a part payment, and then they would use part of that payment to be able to buy the raw materials and process for that customer. So as a result, they were having a lot of quality issues with the feed by buying some raw materials just in time without having enough of their quality assurance processes in place to be able to run properly. And in general, their reputation was going down the line. They had come from one of the top industry players to one that people were skeptical about. And in the poultry feed industry, if anyone tags you as not having good feed, it's a death sentence, because most farmers are very hesitant about changing the poultry feed that they use. So this was the situation when we met them. So when we talked with the board and the management about at the time, we talked about what would we be coming to the table with? How would we change this story, this death sentence that was on the company? So the first order of business when we talked about the value creation activities was to make the plant operational. So that was by providing working capital, but it also meant recruiting people. It also meant going over all their safety protocols, their operational protocols, to make sure that they were going to run the plants properly, putting in place maintenance, stocking the spare parts. So all these operational elements that are way outside what happens in the board, we had to work with the management to ensure that they could get the plant properly operating once the capital was deployed. We also worked with them significantly on sales and marketing, given that they were having a really bad reputation in the market. So they had to really look at how they were going to go around to all the different farmers, educate them about what has changed in the business and why they were back in top form to be able to compete effectively with the other feed products that were on the market. We also had to give them other practical tools, including increasing the fleet management. So bringing new vehicles into the fleet so that they could distribute the feed more easily across the country. One other key element that we brought on board was for raw material sourcing. So in the past, again, partly because of their working capital challenges, they were buying materials on the market, on the open market, which means they get exposed to a lot of quality issues. For instance, with maize, you have aflatoxin issues, you have weevil issues. So, and then you have price issues, because when you go to the market, you just buy at whatever price is there, and that might not be the best price for the end product. So we put in place an outgrower scheme, and this again is because private equity has a long-term view in terms of how it works. So the outgrower scheme involved identifying smallholder farmers, investing to give them seeds that they could grow into the maize products, and having contracts in place where they would sell the maize to the company at the end of the season at agreed prices with specific bandwidth. So this was also ensured as part of the contract process. And this, in terms of value creation, when you list the initiatives, they might seem very few in terms of the number of bullets, but in terms of the impact on the bottom line, these are very significant. And this again is where you start seeing the numbers translate into the financials that we'll see shortly. So this was a very important initiative to put in place for the company, especially in a year like this where there is a shortage of maize in the West African sub-region. A final element we put in place with Agricare was their R&D to continuously be looking at new local raw materials that they could use or ways of combining the existing raw materials to increase the quality of the feed while not increasing the cost price. Now, fast forward from where we started, when you look at the pre-investment numbers. So we started from a revenue base, which was nothing to write home about. It was just under 1 million cedis. And fast forward to now, it's over 24 million cedis. They were not profitable when we started. They're just finally in the black, around 1.6 million cedis. And again, because we put in the outgrower scheme for their maize, now they have a network of almost 1,200 smallholder farmers that they are working with. And this can be clearly seen in terms of their sourcing of raw materials. So they used to have a penchant for just placing orders and importing maize. But with the scheme now, when you look at the amount of maize they purchase locally, in the past it was around 342,000. Cumulatively, since we invested, is about 44 million. So this case we've particularly highlighted to tell the story about how activist private equity is vis-a-vis the listed assets classes, where once you place your funds, you just wait for the period to elapse and you decide to liquidate. So if it was a T-bill and it was 30 days, at the end of the 30 days, you get your money returned with whatever the interest rate is. For private equity, it's hands-on, it's sleeves rolled up from when you invest until when you return the money to the investors as well. I'm going to conclude with an offer that we have on the table for the pension trustees that are interested in private equity. So we happen to be on the market with a private equity vehicle. So this has already been approved by the NPRA as well as SEC, and our target launch date is mid-year, 28th of June 2021. So it's a 150 million Ghana cedi fund with a hard cap of 200 million. And again, it's set up traditionally as a private limited liability partnership. And it's going to be domiciled here in Ghana with a primary focus on Ghana, although we can make some investments in La Côte d'Ivoire. So it's a 10-year life. It's extendable by a year twice. This is fairly standard with private equity vehicles. Now, this is not an agric fund, it's a generalist fund. So it's looking at food, agribusiness, basic needs, industrial. So by basic needs, it includes financial inclusion, healthcare, and education. So in terms of other key metrics for this particular fund, the target return is 30 to 35%. This is in Ghana cedis for the gross IRR, and the holding period is going to be about 5 to 7 years. And we're going to focus on SMEs. The management fee is also in the range as most traditional PE firms 2.5%, with the GP committing to put in 1% into this particular fund. So as Alex mentioned at the beginning of this particular day's deliberations, he talked about the fact that there is a growing need in the market for companies for funding. However, access to that funding is quite difficult, and that's because of the traditional setup of our financial markets here in Ghana. We are quite oriented, and we are very, very good when it comes to our understanding of the listed asset classes. But for private equity, it's new. Naturally, there is a lot of misconceptions, a lot of misunderstanding that also exists for that sector. So for us, this is a wonderful opportunity to meet you, to hear your questions, to understand your questions, so that we can begin bridging that gap for you to better understand what we have to offer, and also to get you to the point where you can commit to making investments into PE fund managers. Because the more we have this happening, then we're going to start seeing the examples that I think you're all looking for to make the cases to your various boards to be able to support. So very grateful for this opportunity to share our story with you, and very excited about the Q&A section so that we can keep the conversation going.
Thank you very much, Mirabel, for your presentation. And I noticed that once you came up, people were excited that at least we have a feminine face showing up. So at least we are thankful that you joined us to do this presentation. Because of time, and again, I'm going to restrict myself to just about a question or two for you, and then we'll move the rest of the questions to the Q&A panel discussion, if that is fine by you.
That works.
Okay, so the first question says that good presentation by Mirabel. I think it's a similar question that we had Matthew respond to earlier, but you can also take a bite at it. What sectors would you recommend for economically targeted investments to propel economic growth in Ghana?
So basic needs, food and agri are the ones that we have picked for IGVCF, and we didn't pick these particular sectors lightly. So when you look at the makeup of the Ghanaian economy, of where people are primarily employed, where there are productive inefficiencies, and where scale is going to make a lot of difference, both scale from a capital perspective and from a managerial perspective, I would still highlight food and agribusiness as well as basic needs. Okay,
and the last question for now would be from Kwame Odame, and he says that, are the risk-adjusted returns superior to traditional asset classes with regards to PE?
Generally, yes. So at the last check, when I looked at some of the stats, the Ghana Stock Exchange was sub 10. And when you look overall at private equity venture capital across Africa, it was mid teens, 20%. So generally, yes. And again, it makes sense because as an asset class, it's not liquid. And so if you're doing your job well and building value within those companies, when you're ready for exits, then the market will recognize the efforts that has been put in place. Unfortunately, because again, you can't be trading private equity on a regular basis. It takes a while to be able to build that story and then find the exit partners that understand that story and buy into it and give those kinds of returns that we're seeing in the continent.
All right, thank you very much, Mirabel. We are very grateful to you for the wonderful presentation. Everybody is congratulating you on such a good and brilliant presentation. Thank you very much.
You're welcome. And one last comment. So I can assure you that at least in the private equity space, I do have a lot of accomplished female associates across various firms, including Oasis and a lot of other firms. So I just happen to be in the minority here today, but we are a force to reckon with in the field.
Certainly so, certainly so. I couldn't agree more. Thank you very much, Mirabel. So ladies and gentlemen, like I said from the beginning, this is supposed to be a very, very interactive session, and we are moving into our panel discussion where all your questions would be addressed by our panelists. Let me also say that we still have Kweku Adoboli online. We still have Tony online from Bro, and then we also still have Courage also, who is online. So for those of you who probably still have questions from yesterday, which wasn't responded to, you can still put them in, and we'll try and get Kweku, Tony, and Courage to also respond to it in due course. So please keep your questions coming. For the next about 30 or 45 minutes, we'll have a panel discussion. And this is where we'll take all your questions that you may have and have our panelists respond to them, as well as those who did a presentation from yesterday. I'm going to introduce our panelists real quickly, and I would introduce our moderator as well, who will be helping with the panel discussion. Our first panelist is the Chief Investment Officer of IC Asset Managers. He is in the person of Isaac Boama. He has a CFA. Hello, Isaac Boama. It's good to see you.
Hi, Jeff. Good to see you. Hope you're well.
Great. I'm very well, thank you. The next panelist I would also introduce is Kwabena Boama, Chief Investment Officer, Stanbic Investment Management Services, Ghana. Hello, KB.
Hi. Good morning.
Good morning, and it's good to see you once again. Great. The next panelist is the head of DataBank Asset Management Limited in the person of Ni Ampa Soa. Hello, Ni.
Hi, hi, Jeff. I think my camera is malfunctioning right now, but
I'm sure it will come up before we start the conversation. So it's good to at least hear you.
Okay, thank you.
Great. The last panelist for the conversation is the Chief Investment Officer here at Axis Pension Trust, Nana Wiafi Boama.
Hi, Jeff.
Hey, Nana, how are you?
Cool. Thank you for asking.
Great. So I'm going to hand over the panel discussion to our moderator. Our moderator is a managing partner at Blackstar Advisors, and he's in the person of Eric Appiah. Hello, Eric. Great. You may have to activate your microphone. I think it's still inactive.
Thank you very much. Yep, technology. Great.
Yeah. So, Eric, I'm going to hand over everything to you going forward. And let me also mention to you, Eric, that we have a whole lot of questions that are sitting on our dashboard. And so when you are going through your conversation and you are ready, I'll start reading them out to you so that you can have your panelists discuss it as well.
Sure, great. And thanks for that, Jeff. So I think the way we will do it is tackle just as we did in terms of the program, which is tackle the economic, come very quickly to MBS, REITs, and then go into the private equity and private debt side. So at least that we get to cover the 2 days worth of events. And I have to say, what a show it's been. For a lot of you who are watching this, I look at KB's background, I look at Ni's background, I look at Ike's background. And for me, I suffer from PTSD when I see those backgrounds because I spar with them constantly when we go to them to sort of introduce new transactions to the market. But they're great conversations we have about how our industry develops. Now, to give all of us a sense of the size of the industry we're talking about, assuming our current industry is around 21 billion cedis and 15% of that can go into alternative assets. That's almost 3.5 billion cedis we're talking about here. So this is not a small amount of money. It's almost just over $500 million we're talking about. So it's a huge asset class. And I think the NPRA has said you can't do it's more than 15%. So if we were to give, let's say, even 5% of that to our private equity brothers, and we give the other part to REITs, etc., that's a significant amount of money, almost $175 million that can go to each one of those categories and can be transforming for the lives of Ghanaians overall. So what I'll start with is just the economic side. And we've had a great presentation from Courage and Carl, but one of the key things that comes up is the debt, the amount of debt we have as a country. And I was just wondering, and Courage, this is perhaps a question for you before I go to the panelists, is what's your view on the debt suspension initiative by the World Bank? And is that something that you think makes sense for us at this stage, to be able to give some fiscal space to allow the government to breathe so that the programs that they're carrying out can be done in a successful way?
Well, thank you very much. Good afternoon to the participants on the call. I think the proposal from the IMF and the G20 group is one that would have to say it has pros and cons. And so when you decide to take advantage of it, we need to weigh both the pros and the cons, or the costs and the benefits of taking advantage of it. It started with the DSSI, which essentially, as the name implies, just a suspension of debt service. And when you look at how it is implemented, it's actually meant for countries or debtor countries that are facing temporary liquidity challenges. Now, it has been discovered that in itself is not sufficient to deal with the long-term issues of debt sustainability or solvency issues. And so beyond the DSSI, the G20 group have come up with this other technique of dealing with the debt issues, which they call the common framework for debt treatment. And this is typically for countries that are facing solvency issues as far as debt is concerned. When you want to get it, it has to come from the debtor country itself. So it will not be imposed on the country. The country has to decide voluntarily to take part of it, and then the processes will be triggered. The one major advantage when you apply is that you get the opportunity to bring all your creditors to the table, and then also you are able to get them to agree to similar or comparable terms, so that then you are able to get a way out of your debt issues to be able to make your debt more sustainable or reduce your debt burden over time. The common framework ensures that they bring about new repayment schedules, new interest rates, and other terms of the loan contract, as opposed to the DSSI, which just suspends your debt service, maintaining other terms on the contract. Now, the possible disadvantage of joining or applying for this, and I want to say with the specific case of Ghana, there has been no indication that the authorities are prepared to join. In fact, the clearest indication we got towards the end of last year from the governor of the central bank was that we are not ready to join, because, and as I agree, because it may have dire consequences for investor sentiment or perceptions about our credit quality. And but there are countries that have joined or that have applied, most recently Ethiopia. Now, when you decide to go for a debt treatment, the common framework, it has implication for your yields that you get when you go for the next issuance or you access the market again. Now, using Ethiopia as a case study, it is quite informative or quite revealing, because Ethiopia decided to announce their decision to apply for the common framework. What did we see? Within 48 hours, yields on Ethiopia's outstanding Eurobond spiked by over 230 basis points within 48 hours. Now, why so? Because the market sees that if you are to go in for a common treatment, one of the conditions within that framework is that other non-G20 creditors must agree to similar terms as agreed by the G20 or Paris Club members, which would include even Eurobond or private commercial creditors. And this didn't sit well with holders of the 2024 Eurobond for Ethiopia. And so yields spiked on that front. But when you look at why Ethiopia would decide to join, you will realize that Ethiopia seems to be taking advantage of the opportunity because Ethiopia, as at now, does not have access to the international capital market based on the ban or conditions imposed upon them by the ongoing IMF program that they have signed up to. Now, you look at the debt to GDP ratio of Ethiopia, it is about 56%, which is just around the median debt to GDP ratio for B-rated countries. And it is better than Ghana's debt to GDP ratio of 74%. So you wonder why Ethiopia will seek to apply for a common framework. Now, when you look at Ethiopia's Eurobond, they have just about $1 billion outstanding. Ghana has over $10 billion in Eurobond. But it came out clear that Ethiopia is taking advantage of the situation to bring China to the table and get a renegotiated debt payment or debt service situation, because Ethiopia currently owes China about $8.4 billion. And you look at Ghana, we owe China just about $1.8 billion. We have access to the market currently. We have to go onto the market. Ethiopia doesn't expect to go onto the market. So this situation presents an opportunity for Ethiopia to get other creditors, especially China, to the table and renegotiate for better terms, because they wouldn't be going to the market anyway. But Ghana is going to the market and might not have to do that.
Sure. No, thanks. That's great. And sorry, I'll pass that question over to Nee. So, with regards to our debt issue that we have, how are you looking at managing your mutual funds in this sort of environment? And then maybe to KB, thinking about the pension fund side, how are you looking at that? And then I would say also to Ike, in terms of if I am a high net worth individual, what should I be thinking about? But I'll start off with Nee first with regards to the mutual funds and how you position yourself in the current economic environment that we have.
Okay, thank you, Eric. So it's a bit tricky, in part because of a number of things that have happened in the market recently. As you all know, with the financial sector crisis, investors have, in a sense, woken up. They're a bit more alert. They're a lot more sophisticated. They ask a lot of questions. They push you to the wall. And that's on one end. The constraints that we have on the other side are that they still have the bad habits of being high return seeking, and they have a low tolerance in terms of risk. And with that in mind, it more or less pushes us into a certain corner of reacting. So yes, Alex made a comment very early on about exposures that we have to, I guess, Government of Ghana securities being quite elevated. That indeed is true, but the alternative is what? What are the other returns on other securities yielding? It's not really that competitive. And at the end of the day, because you're out there in the market and you're quite visible, there is some kind of pressure to move you into the position of investing in Government of Ghana securities. As far as questions we're asking ourselves going forward are concerned, Courage touched in yesterday's presentation and a bit now on the economic situation and the fact that we do have a deficit and there is a hole that needs to be plugged. The questions we ask ourselves is, well, how would that hole really be plugged? Would it be a domestic solution where you may see a lot of issuances locally, which could then lead to a spike in interest rates? We believe that is justified, but will that happen? It doesn't appear to be happening. We are rather seeing the reverse take place, with yields being a bit more depressed. And obviously with the Eurobond that is slated to come up within the first half of the year, the government has a viable option to duck or sidestep that question. Fundamentally, we don't believe the current yields are really supportive of the fundamentals. Interest rates ideally should be a bit higher, but they are not for a market dysfunction reason. I hope that answers the question.
No, that's great. And then Kwabena, just in terms of how you guys are looking at your portfolios, etc., that would be great.
Thanks, Eric. I'll just pick it up from where he left off. And he's absolutely right. If you look at the macroeconomic indicators and where interest rate yields are, but I can understand what's happening. because beyond the macroeconomic indicators is also the factor of demand and supply dynamics. And if you look at the current situation, you don't only have foreign investor interest, you also have local participation as well, which have gone up considerably over the short-term period. So you have a situation where the government is looking to raise funds. A lot more people are ready to give him money. It doesn't make sense for him to go for the highest cost. So I think what's pushing the yield curve downwards has to do more with the demand and supply dynamics as we see now, the liquidity supply. And that is also understandable because, like Nii also said, credit risk and also from courage due to the slow economic recovery has made institutional investors quite risk averse. And therefore, the safe haven that we are all looking towards to our Government of Ghana securities. So in terms of what we are looking at investment for clients, I think Carl did mention that the equity markets are trading at 10-year lows. And obviously that gives you a good place to look at in terms of trying to pick up some considerable returns when the market recovers. On the fixed income side, yes, government still continues to be the dominant player, but we're looking at on the yield curve, positioning yourself in between the belly of the curve where you can lock in some good rates if yields continue to persist downwards. But at the same time, given the macroeconomic situations, you don't want to be over optimistic in terms of downward trends, but position yourself such that you can unwind if the trends turn the other way around. So it's still fixed income, Government of Ghana securities, given the credit stance in the economy. And then also, if these trends continues, I'd see some positive issuances probably on the alternative space, which will also provide an avenue for capital to flow into that area.
Sure, thanks. And Ike, your views, please.
All right, thanks. Good to see you. Just on a lighter note, we just coming from a conversation with private equity guys who want assets from the pension fund guys. And now you have the pension fund guys complaining that yields are low, which is quite interesting for me because once yields are low, that means cost of capital for businesses will be low, and that should be good for our economy. So it looks like we want to eat our cake and remain slim and have it and not go to the gym. I mean, one economic participants, they want yields to be low so that businesses will thrive. And then you have the portfolio managers who are complaining that yields are quite high. So just on the broad economy, I hear the conversation that debt levels are high. It's mainly coming from two costs. The first one being the COVID, which has basically added about 10% of our GDP in terms of debt. Then we had previously the financial crisis, which also had a similar size of debt to GDP. So you're talking about 20% or so debt to GDP that we have incurred as a result of COVID and financial sector. However, when you scan across the entire sub-region in Africa, debt to GDP has gone up by 10% because of COVID. In the developed world, it's also gone up by probably 15 to 20%. So our macros are out of shape, but we are not unique. It's cut across board. Now, what I hear is that too much money is chasing too few ideas. That's what is happening in the market. Just in January alone, transactions in terms of bonds was about 18 billion, which is the highest in a single month we've had over since we started the Ghana fixed income. Now, if you look at yields on a 10-year US Treasury, it's about 1.3%. So even if you have a 1 year, people are 16.5, 17, and given what currency depreciation has done over the last 5 years, I would discount the previous 5 years before the last 5 years because of what you had in 14, 15, which was basically an outlier. You're looking at about 9 or 8%. So even if a 1 year gives you about 17 in dollar terms, you're looking at 8, 9% in today's market where market is awash with cash. So I think that's great. Now back to the question of high net worth individuals. I think the real key is that when the music stops, which is in terms of liquidity, things will become complicated. That's the truth. So what you want to do is to position in such a way that you get out before the music stops. At the moment, you still need to dance to the music because that's what it is. So the Eurobond levels have elevated quite significantly, but it has come off in recent times. At the moment, if I'm a high net worth individual, I'll probably look at the 1 year Ghana paper, which probably you can get 16.5, 70, which could give you a 10% on the USD. I hear the story about equity. My only concern for equity in Ghana is that it's not that liquid. I probably will look at certain undervalued emerging market equities outside of Ghana, just because they might thrive on the back of vaccine rollout and they might make some dollar in addition. If you get a good undervalued real estate property, you should consider to add it as a high net worth individual. So those will be my combination that I'll offer to a high net worth individual, which I believe you are one of them. How that helps you.
Thanks. And over to Nana, who looks like he's dancing to the music. He clearly is the trustee who has an eagle-eye view over all the portfolios. So Nana, from your point of view, how are you seeing your fund managers in terms of the economic outlook? Are they generally trending towards where Ike and Nee and KB have sort of pointed, or you are seeing sort of a mixed view coming up from your fund managers from a trustee's point of view?
Thanks, Eric, for the question. So I generally agree, with the views, expressed a while ago. What we do, over here is we are kind of into, compliance. When I say compliance, complying with our asset allocation. So, for equities, much as Ike is not, so bullish, we have our strategic asset allocation, and what we do over the period is to buy. So last year was interesting. We kept buying, and that lowered our CD average cost. And we've seen some rebound, which is kind of providing a boost to our portfolio. Of course, our asset is predominantly denominated in fixed income, where we have pretty much over 90% of our asset invested in fixed income, but then we try as much as possible to seek out opportunities across the investment ecosystem. We do have some allocation, to private equity, via, Stanbic in Oasis. We've made some commitment to Njaro. We generally, believe a well-diversified, portfolio, provide that enhance risk return, for the benefit, of course, of our members who are retiring 10 years, 15 years, 20 years from today. So we are not so much obsessed, with fixed income, but then we do it because currently, it provides, the greatest opportunity, whilst at the same time pushing some resources to equity, which we believe is so much undervalued. And then when we get a great private equity, manager with integrity, we try as much as possible to test the waters, with them. So that is basically where we are as a trustee.
Sure. No, thanks. So what I wanted to do after this was just to ask Jeff if there are a couple of questions we can take, and then we'll move to the next session, which is I think we should just take two, just because there's quite a few things that we want to discuss. So if we can take two questions that the panelists can answer, that would be great. And that could be from the economics, the section that we have.
Yeah, I'll just go through quickly some of the questions that we already have. I think the one that readily hits my desk has to do with, just a second. What role can the private equity play in helping companies in the financial space in meeting minimum capital requirements in Ghana? This is from Emmanuel. I'm not sure if you would direct it to somebody.
To leave the PE question a bit later, just so that it goes in that format, so we could just clear that out. Maybe I should have given you a heads up, so apologies for that. But I think there was a question, and maybe more directed at Nee, where there was a question around how you manage. Obviously, you need great fund managers to be able to manage in this kind of economy. And I think the question was around how do you generally pick your fund managers, or how do your fund managers come to generate the ideas that they do in order to manage the portfolios in this kind of environment?
Okay, thank you, Eric. Yes, it is indeed a challenge. So the way we do it here in DataBank, you need to have your ears to the ground, I guess read a lot, communicate a lot with the market. A number of the people on this call, Ike and KB, we speak to on a regular basis. We compare notes and ideas. But also, I think the onus also is on us to speak to market participants, not just even trustees and stuff, but investee companies as well, and really get a sense of what is out there on the market. The second thing I think is key to what we do would be with having a framework for assessing a number of the opportunities that are out there. I can't immediately reveal the secret sauce to our formula, but what I can say is that it's not a one-size-fits-all technique. Yes, depending on whatever asset class it is, there may be a certain framework that you look at. But ultimately, some of the things that Matthew said, I think are important. The manager or the entrepreneur is key. The management team is important. In this particular era, especially after the financial sector crisis, we've come to see that governance in itself is very important. And I know we are going to talk about PE much later on, but what we have realized also in the limited DD we've done with PE firms relates to exits. It's not talked about often enough, but really at the end of the day, we are in this to the point of realizing an exit. And if there isn't a demonstrable exit track record, it's very difficult to sell, because at the end of the day, yes, the thing will be revalued every 6 months, but I can't be holding on to paper gains and losses. I have to be able to see and appreciate and realize an exit at the point of exit. And I think that really is important to emphasize.
Sure, no, thanks. So I would move on to the next section, which for me would be on the REITs. And we have Tony. Thanks, Tony. I know you've been here yesterday and been on the call for a long time, and definitely Kweku and I have also had a fair bit of sparring with regards to the mortgage market, I think probably about 1.5 years ago or so, which was great. So, my key questions around REITs and MBS, and probably relates more to what Nii is saying, the exits that investors have in terms of the asset class is pretty illiquid. And so how do investors sort of address that illiquidity? And maybe I'll start with you, Tony, on the REIT side, and I'll go back to Kweku on the MBS side, how that liquidity plays on your side. So Tony, please.
Okay. On the REIT side, that's basically what the REIT is meant to resolve, the liquidity of such property investments, because real estate by nature is very illiquid, and then the exit is usually the span of the investment cycle is usually quite long. And basically that is what these REITs are meant to resolve, because it's virtually traded, and therefore it is quite very easy. The entry and exit is really relatively easy. So I believe that the REITs have brought through that sort of innovation in the market, or will bring that innovation in the market, where the investor can easily exit their investment if they wish to at any point in time. Yeah. Okay, I believe it's answered, Eric?
Yeah, sure. No, sorry, thanks. I was speaking a quick just on your side and MBS.
Yeah, again, with the entire Ghanaian market, in fact, with Africa generally, the key issue is how do you release liquidity from the assets on the ground? It's all in every asset class, from housing to physical assets under the ground in terms of precious metals, etc. How do you release the liquidity and deliver that to people who need to invest it and redirect it in order to make an economy that works efficiently? The reality is the idea behind creating a mortgage-backed marketplace is that it is designed directly to allow for growth in individual private sector bank balance sheets by taking away the illiquid asset and replacing it with new balance sheet funds, which they can then redeploy, whether it's to mortgages or to another sector where cash is required. But the point is that you need to release the balance sheet assets because they are highly illiquid and they are in terms of performance for the banks, in terms of returns, are non-performing. So the idea is that if the pension funds who are sitting on increasing piles of cash, as the economy becomes more formalized and more people contribute to their pensions, the pension funds become increasingly powerful because they have all this capital and they can assist the banks, right? It's a transfer mechanism. They can assist the banks directly by providing liquidity, which we would normally need to go outside for. The idea behind mortgage-backed, it's basically coming in at the base level of the economy to release assets from the banks, which we think, again, it's really fundamental. It seems really complicated, but it's the bottom level stuff that we need to do, the low hanging fruit that allows everything else to start to propagate better.
Sure. And Tony, just another question with regards to REIT. So we've just spoken about liquidity, but valuations are really important. And for the REIT, as it's a structure that means that rentals have to be paid out almost 80% in your presentation yesterday. But in Ghana, we typically have very short lease periods. I mean, in Europe and other places, I mean, you have companies renting buildings for 50, 60 years. Whereas in Ghana, I think you struggle to find anybody who probably does more than 3 or 4 years. How do you manage that in a REIT where the certainty of cash flow is reduced after a defined period of time?
The beauty of introduction of REITs in the market is as meant to release adequate capital for certain forms of investments. Traditionally, as you rightly said, some of our leases or most of our leases are relatively short term. We're looking at a current market lease period of about between 3 to 5 years. However, with adequate capital in the market, it actually provides us with certain options or certain investment options. For example, we will be looking at, say, sale and leaseback transactions where, okay, if I may just give you a background of what has been happening lately since 2016, where most of the supply of office space has really been owner-occupier space, where you would see that the big corporates like the banks have been building their own headquarters, particularly if you look at Independence Avenue and an Airport City, you will find that most of our big banks have built their own. You see Stan Chart have put out quite a lot of space on the market. MTN have done the same. And those are basically some opportunities that are sitting there waiting for investors to take advantage of. In advanced countries, they have actually looked at such very big corporates with very blue chip balance sheets and then approached them for sale and leaseback options. Those are the sort of transactions that we're looking at if there's enough liquidity in the market, where we could take advantage of such positions within the real estate space. Because a sale and leaseback option, for example, gives you quite a long-term perspective because such corporates will be in there for at least 20 years anyway. So most of the time we're looking at a span of about 20 to 25 years when you have a sort of sale and leaseback transaction of this nature. So that gives you an example of what liquidity and adequate capital in the system can do by providing such investment opportunities. However, with respect to back to your own question regarding the short-term span of such leases, the rental cycle anyway, usually kind of, like I said, spans between the 3 and 5 years option, but you will find that most of the time these are renewed anyway in the space within that period. So yes, there is a little bit of income risk, but yet you will find that most of the time these leases are getting renewed. Plus, even with that 3 to 5 year span, it gives the landlord or the investor the opportunity to actually introduce new brands. If, for example, it's retail, to introduce a new brand into a mall, for example, that will give better life to a mall, which adds better value. So sometimes there is an advantage anyway to having a short-term lease, such that you are able to, it gives you the option to be able to change the look of a portfolio or a particular building.
Sure, thanks, Tony. And before I go to Ike and KB, what is the sweet, and I'll go to Ike and KB to ask them which of the two they prefer in the current environment. So be it a REIT or an MBS in their portfolio. But Tony, what do you think is the sweet spot for the sector? So is it residential? Is it hospitality? Is it commercial? What's the sweet spot that you currently see in the market in the Ghana context?
I'll say that in terms of trends, commercial gives us a better option, particularly for the sake of longevity. Even though residential has or is basically a fundamental need for every population, I believe that from the business perspective, commercial offers us a very long-term advantage when you're looking at it from the investment perspective, and then the general outlook within the market as we see it.
Sure. So KB, how do you like them REITs?
I think the both are options that are attractive to us, especially if you have a situation where yields are declining, and then also it opens up for these instruments to become more attractive. The major issue is not much of the portfolio managers or the asset managers as much of the clients whose funds that we manage. So even though liquidity has grown over the years, I think our risk profiling of our clients has barely changed over the years. And even though there's some changes as far as the investment environment or industry is concerned, we haven't had much of a change in the risk appetite of our clients. But I would pick the MBS, I'll pick the REITs any day, any time, so long as the underlying assets are solid enough and can give us that sense of rental income that we're looking out for.
Sure. And Ike? MBS or REIT for you?
Thank you, Eric. I feel like this is anyway. So just given the fact that COVID has changed the dynamics for everyone, I mean, who could have envisaged that all of us will not be in one single room? We are all scattered across. Some are in their homes, some are in their offices working. I will restrain from REITs at this moment and probably be a bit more biased towards the MBS, mainly because most of these MBS, they are financing people's primary residence. So if you give me under the same condition, I probably will take MBS at this moment than REITs, if you ask me.
Great. I'm bringing the prospectus.
I need a question.
No, Eric.
I have you on record. There's 200 people on here. I have witnesses. We're tied. We're done. Tony, don't worry. We've got you covered. Kwaku, we've got you covered.
Well, I said terms and conditions apply.
And me, for you guys, I know you've been intimately involved in property as well. So what are your views on the two, sort of the REITs, which is more equity-like, and then the MBS, which is more debt-like?
Well, so what I think, just to address Ike's thing, I would prefer REITs, but maybe not in the traditional sense. I guess the question really is what the underlying is, which sector it targets. The REIT, I don't think there are any local options that are available, but I've been reading a lot about storage, warehousing, and also data centers for cloud computing. I mean, if the likes of the hospitality and office market has been disrupted, that has certainly moved somewhere. So if we are working from home and there's going to be a greater need for cloud computing, what is to say MTN would need a cloud or data center somewhere that perhaps we can invest in, and that could be our REIT solution. So, I mean, if any of those opportunities were to come up, that would certainly be something that we'll look at. As an aside, we do have a fund, and I think one of our flagship funds did invest in a REIT-like structure, which is dual listed. It used to be listed in SA. It's primarily listed now is in Guernsey, and it's cross-listed in the Stock Exchange of Mauritius, GRIT, which I think Tony made reference to yesterday. So we do have an appetite for certain structures in that front. The timing, per what I could say, may not be right, but then again, depending on really what sectors are being targeted underneath, it could be a good opportunity to get in now.
Sure, thanks. And I think none of this can happen without one person. So Nana, please, we just need the go ahead from you to do either REIT or MBS. How does that sit for you from a trustee's perspective?
I think I'll go with NIS, view. If I get, a rich structure that has buildings like the Stanchart head office, upcoming, ABSA, Stanbic Heights, where KB sits, why not? I'll buy without thinking twice. Again, the pandemic, has brought this work from home thing to fall. So obviously, demand, for housing, I don't know, depending on how income grows over the period would increase, and that makes the MBS, sector, also, quite attractive. So I am for both. It depends on the underlying assets within those two structures.
Sure, thanks. And for Kweku, probably the last question on this section. In terms of MBS and in terms of tranching, typically when you've created the MBS structure, you would have your senior sort of tranches and your equity tranches. What do you think about the idea of the actual developers holding the equity tranche? In that case, we're all aligned in terms of, because one of the things we typically hear from people is a developer builds something for 50,000, he sells it for 100,000, walks away risk-free, goes on to his next project, and then investors are left holding the risk. So the idea was, well, is there a chance that they could actually hold an equity tranche so that we're all incentivized to make sure that, one, if you're developing for the long term, etc. How would that work in the MBS concept? Do you think that's doable?
It's doable. It depends on how we, so the idea is that the structure is supposed to have all stakeholders as equity holders in the first place. So, you kind of go to the Ministry of Finance and the Bank of Ghana and the SEC, and you say to them, look, the best way to make a robust marketplace is if all key stakeholders have, skin in the game. So let's mandate that people have skin in the game, and that they, in order to be licensed to do whatever activities, they're part of the process, they need to be, licensed to an equity holder in this marketplace. And that's one way of looking at it. Another way, of course, would be to look at the bond itself and say, okay, so in terms of the tranches, the equity piece goes to the home builder. Either way, I think it ties them in. For me, the point is that everyone needs to be part of the process in terms of the standards that are being built. If you don't have the home builders as part of the key stakeholders, as equity holders with skin in the game, then they are not incentivized to follow the rules of the standards that guarantee the quality of the marketplace, right? So that's, and the question is, how do you tie them in? And that's what we're looking at. So the way we found to do it is to ask the regulator to mandate that individuals or certain key stakeholders become equity holders in the marketplace in order to be regulated.
Sure, thanks. So I would just open up for questions. I think yesterday there were quite a few questions. So Jeff, I don't know whether you can find some specific questions for the panelists and the other experts in terms of the mortgage-backed securities or the REITs sector overall.
Yeah, so a couple of questions from yesterday, and I'll just share some of them directly addressed to Kweku. So maybe you can be on standby, and then I'll read out some of these things, and then maybe you can have a bite at them. Kweku, so this one was directed directly at you, I think from yesterday. It says, what do you think young people can do to own their own homes without stress in Ghana using your proposal?
Yeah, so it's really difficult, obviously, for young people because it's so hard for them to get capital. Even professionals with first and second degrees are really not earning a lot, and it's very, very difficult for them to then have a piece of money that they can use for their homes. I think that the idea behind all of this is that we need to bring down the cost of affordable homes. So more and more apartment blocks need to be built in Tema, in Accra, in urban areas, so that people can have a home that's worth maybe $20,000. If it's worth $25,000, then if you're earning, say, $10,000, $8,000 a year, then you can afford the mortgage. It's not going to kill you. I have to say that I don't think it's young people's responsibility to find answers to these questions. It's our responsibility to find the answers for them. We have to create more jobs, and we have to create cheaper housing solutions for them. I think to ask young people, if a young people sat there saying, what can I do to own a home? Well, you need to, do your best to find a job that pays you enough. You need to find, find solutions in terms of housing that are affordable. There are many, many solutions, surprising around Accra and Tema, where you have homes that are, basically not in use, that can be acquired for very low rent and then done up relatively cheaply. That's one way to get on the ladder, and then to transition from rent to ownership through relationship with the landlord. I mean, that's one way I would say. But in terms of financing, it's absolutely critical that young people realize it's not their responsibility. All they can do is get a job and earn some money and save some money. If they're not earning enough or houses aren't cheap enough, there's just no options. And that's the problem we have today. That's why multi-generational homes are the way in which we live, where young people still live at home, or they live in very, very poor quality homes in city centers.
Sure. Jeff, before you go on to the next question, I just wanted to throw the same question to Tony. Given the vast number of properties you've seen, where are you seeing in terms of the residential and, for example, that young person trying to get onto the ladder, where do you see the opportunity for them?
It's a very difficult task. As I said yesterday, the entry cost of most of these developments is a disincentive or is a barrier to entry onto the property ladder. Unfortunately, the main thing is how construction cost it's going to be tackled. I believe that it has to be government-led in the first place, where we're able to get a lot of more subsidies into the construction industry for us to bring down the cost of construction and subsequently the cost of each unit. But again, it's something that has to be done. Otherwise, fundamentally, the word affordable is only just a nickname and definitely does not qualify the whole idea of bringing in housing that will be accessible to everybody else in the market. Yeah.
Thanks for that, Tony. Jeff, are there any more questions? I understand we don't have too much time, but yes, hopefully
so maybe one of the questions on the mortgage side as well is, I think there was a question from Matthew. He was asking about, what about construction finance? I'm not sure who would want to respond to that. Construction finance. I think, Tony, if you want to respond to this issue of construction financing.
Yes, again, I raised that issue yesterday, that finance for construction is actually quite high. And that again is also creeping into the final cost of accommodation or accommodation units for the final consumer. So again, it basically is whether or not government will be able to give guarantees to the construction firms or to such affordable housing schemes, such that the banks will also have the comfort to give them affordable rates. Because everything in terms of rates or finance costs is down to the risk involved in the industry anyway. And I believe that most banks and investment firms apply a lot of risk to that industry, particularly because of the history and track record of some of our construction firms here, where you see a lot of delays in construction projects, contractors diverting funds to other projects and things like that we will normally hear in the landscape. So once again, some of the government-led initiatives are very important at this stage. I understand that such initiatives are being provided to GREDA, which is the Ghana Real Estate Development Association, who are in talks with the government for them to provide them with a sort of government guarantee that will give them access to funding, and then subsequently the rollout and these subsidies would affect the final price for the final consumer. So yes, there are things that are being done on the market, but again, it really depends on how government accelerates these initiatives for us to have a proper rollout in the very near future.
Sure. So, Jeff, before you continue, I think Nee and Nana may have to drop off soon. So I just wondering if there are any specific questions for them just before they jump off, from anybody on the.
Not directly at them. So I think there was one that has to do with that. Given the current public debt levels and general economic indicators, what is your expectation of interest rate levels for the short term? I don't know if any of them could take that.
Well, given that Neil will be leaving soon, we can head that one to him. So that's he can carry that with.
Well, the short term. So I think the short answer would be that we generally expect it to remain at current levels as far as the shorter ones are concerned, and the medium to longer dated ones are concerned. KB earlier on alluded to there being a demand and supply factor. So even though fundamentally the story should suggest a rise, we believe in the immediate short term, things will likely remain the same.
Sure, thanks. Jeff, just quickly, how much time do we have left? Because I just want to make sure we're managing the rest of the time. I think people have been on here for a while, so I wanted to just go through quickly on the private equity and the private debts side in a similar fashion to the REITs and the MBS. So I just wanted to know how much time we have left so we can tackle.
We've actually gone past our time. We're supposed to have been closed some 5 minutes ago, so we can quickly give ourselves some 5 minutes to do a quick run-up.
Yeah, so I mean, I guess very, very similar to what we did on the REIT and the MBS side, just from Ike, Nee, and then KB. How do you feel, private equity or private debt at this point in time? I'll start off with Nee again before he jumps off. Then we can go KB and we can do Ike, please. Yeah.
Okay. I think for us personally, the choice would be for private equity. The debt situation, when you're looking at debt, at the barest minimum, you'd likely be looking at the economy and what options are available. And given where interest rates are, it could make the debt conditions for entrepreneurs that may be looking at private debt a bit more expensive. I think an equity option allows you to have skin in the game and would give the entrepreneur a bit more time to properly develop their strategy to realize it to its full potential. So for me, it would be equity, not debt.
Is Eric, I mean, on our side, in a market where you don't have the luxury of choice and options, I think we are open to whatever opportunities that come. We will treat each one on a case-by-case basis. I mean, we don't have options in the alternative space. So if a private debt comes, we will look at it on a case-by-case basis. Who is raising the funds? What are the credit assessments that we need to do on that side? And then once we have the new pension guidelines go through, I mean, it gives us more opportunities in that space to be able to invest. So, I mean, those who are looking to raise funds through different mediums or securities, I would say get the confidence and then come onto the market and let's discuss on a case-by-case basis.
Sure. And Ike?
I'll go for a mixed breed. Go for some preference shares that gives me some cushion to protect myself against currency, whilst having the opportunity to exercise my right to participate in the outside should things go well. So I'll prefer a mixed breed.
Okay. And so, sorry, I'm not sure whether Nana Wiape is still on, but from his perspective and as a trustee, how they're looking at those two asset classes, are your fund managers safe to pick either of those options or they're not safe? If Nana is not there, then maybe I'll throw Pa Kofi under the bus and ask him that question instead.
Hi, Eric. Nana had to step out quickly. But from our side, we prefer a blend of both, simply because of the nature of, our clients. And then we would want to keep the equity portion for potential upside potential. And so that's how we would look at the opportunity on the table.
Look, thank you very much, guys. Jeff, I don't know whether there are any questions on the private debt and the private equity side that we can throw to panel. I know time is fast gone, but maybe let's answer a couple.
So on the private equity questions, I think some of them were directed to Mirabel. I don't know if she's still up. She can come up and then take the question. So there's a question as to whether Injaro looks at only at limited liability companies, or you also look at sole proprietors as well. Sorry, Mirabel, I think your microphone is out.
Yes, sorry about that. So Injaro will look at both sole proprietorships and limited liability companies. However, if a particular transaction is structured with an equity component, then that company would have to restructure into an LLC before that instrument can go in. So that's the short answer.
Okay. Maybe the last question to you, which was equally directed to you, Mirabel, was that you mentioned about educational gap in the private equity space, and what is Injaro doing to bridge the gap in this private equity space?
So we've been hosting a few town halls, and I've posted our email link to the platform, so that if any firm is interested in having us come around to have this kind of session, we're willing and able to do that. We have done that in the past with other PE firms, including Oasis. So this is an ongoing effort, and just do reach out and we'll come around and share what we know about the space.
Okay, thank you very much. Eric, I think because of time, we probably will have to end the panel discussion here. Maybe we could do is to try and put the questions together, forward it to the respective people, so our resource people would respond to it. Now we have contacts of all our participants.
Sure.
Does that work for you?
Yeah, no, that's perfect. I think at the last conference, I think I proposed that we have an after party session where those who had to leave could leave, and then maybe if some of the panelists wanted to stay on and sort of address questions, then they will be free to, because I think from the last, there were still quite a few outstanding questions people wanted to ask and just interact. So I don't know whether it's possible for us to sort of end the webinar as it was, but if there are some panelists who want to stay on and answer questions and interact, maybe we can do that for half an hour in addition. That, I mean, again, I'm good at throwing people under the bus, so this wasn't pre-planned, but if you guys are happy with that, maybe we can consider that for the purposes of this conference. So we can end it so that those who want to leave can leave. And then we can just sort of have just open session where people can ask questions and the panelists who choose to stay can answer.
Okay, that is fine. I think we can easily do that, but we need to take a closing remarks from a representative from the NPRA. He's the director for research, planning, monitoring, and evaluation. And so maybe when we take the closing remarks from the director from NPRA, we can come back to have that a bit more of a further conversation. So thank you to Eric, yourself and your team very much for the panel discussion. We will try and have the after party maybe after the NPRA representative has spoken. Okay, so I'd like to invite to give a closing remarks a representative from the National Pension Regulatory Authority, Mr. Emmanuel Ernest Amate-Vondi. He is the Director for Research, Planning, Monitoring, and Evaluation at the NPRA. Hello, Mr. Vondi.
Yes, Jeff, thank you very much. And let me thank Access for invitation to participate in this conference. And indeed to congratulate all the panelists. I've been very well informed about what's been taking place, and I think that I'm quite excited about it. Secondly, let me apologize for the absence of the CEO. He had hoped to be present, but some other equally important assignments has taken him away, so he couldn't be present. So he's asked me to read his brief address to the conference. But before I do that, let me acknowledge all my good friends who have served as panelists. It looks like some of them I haven't seen for a while, so I'm just excited to see them share, their knowledge and experience on these matters. My observation is that it looked like it was a panelist of the Buames. Isaac Buama was there, Kwabena Buama was there, Nana Buama was there. The only difference is Eric, my good friend Eric Apia. So I'll add Buama to his name, Eric Apia Buama, Ni Ampasoa, add Buama as well. But let me congratulate you. I think again, I will say that I will read briefly the address by the CEO, which he's asked me to do on his behalf to the conference. So I'll read it and then we take it up from there. Mr. Chairman, management and staff of Axis Pension Trust, resource persons of the conference, invited participants, distinguished ladies and gentlemen, I wish to thank you for the invitation to speak at your 2021 conference and to give the closing remarks. This effort by Axis at knowledge sharing and knowledge promotion is laudable and worthy of commendation. Indeed, we at the Regulator's Office recognize and appreciate the significance played and continues to play in the pensions industry in Ghana. We highly praise their efforts at that. Economic security in old age is an integral part of every individual's well-being, and pensions are intended to offer people this security once the worker or employee can no longer earn their living themselves. Pension schemes have therefore become a modern mechanism to provide retirement income to the aged for the maintenance of their standard of living, and also be seen as a financial security system for the welfare of the aged, with its core objectives being poverty relief and insurance. In other words, pensions provide protection to people to prevent them from falling into poverty at the end of their working life. Since it is a reality that today's worker becomes tomorrow's pensioner, matters to do with pensions and retirement are of immense interest to the Regulator's Office. We take note that the COVID-19 outbreak that began about a year ago has spread worldwide from the early part of the year 2020 and has triggered a global health crisis. It has led to business disruptions everywhere and in all sectors, including the pension industry. This has prompted an economic and financial crisis worldwide, and various countries have introduced preventive health measures to curb the spread of the virus. Economic activity has slowed down across the globe, leading to soaring unemployment, among others. The COVID-19 lockdowns and the related economic downturn has had significant impact on pension schemes, pension service providers, and regulators. This impact has the possibility to lead to lower incomes in retirement and dysfunctions in the pension industry, and relevant measures are being thought through to mitigate the effects of this pandemic. On a global stage, COVID-19 and the economic lockdown has in general led to a large fall in the value of equities and fixed income securities, which are the main assets for global pension fund investments. Financial markets have been made volatile and sensitive to the evolution of the outbreak and its impact on the global economy. And as a result, the market value of pension funds have suffered a significant reduction in the first quarter of 2020. Already, in a number of countries, many contributors to pension schemes have lost their jobs following the COVID-19 outbreak, and others have seen their hours of work reduced. Spells of full or partial unemployment have led to contribution gaps of employees or employers contributing to pension schemes. Employers are equally facing difficulties in paying wages and contributions to their employees' pension plans as they experience business downturns. A salary loss or cut could reduce voluntary pension contributions as people are less likely to contribute voluntarily to pension schemes when they are under financial strain. This is the situation we find ourselves in that confront all of us and which we have to make relevant efforts to address. Ghana's pension reform implementation is about a decade old. The relevance of the reform has been influenced by the need for diversification of the sources for retirement income provision and enhancement of retirement income. The pension assets accruing under the reform has been significant, particularly the private pension schemes, and we anticipate that this trend will continue. The theme of this conference is of much interest to the regulator's office. We assume that most of you may have been informed of the efforts to put in place the new investment guidelines for the pension funds. In developing these guidelines, the NPRA has provided minimum standards aimed at achieving the following objectives. 1, to ensure safety of assets and fair returns on the funds. 2, to give contributors a range of investment options. 3, to enhance the ability of the trustees and fund managers to make sound investment decisions. And 4, create an environment that enables pension funds to impact positively on the Ghanaian economy. The asset classes include alternative investments, which is defined to include 1, real estate investment trusts, private equity funds, private debt funds, external investment, project finance, direct property investments, and infrastructure bonds or funds. A lot of capacity building has to take place to assist the industry to appreciate these instruments better. And I hope the CFA Institute and the service providers, particularly the fund managers, will cooperate to make this happen. To conclude, let me mention that contributor savings for retirement need to stay on course and be well invested. Ultimately, there is need to develop close cooperation with all stakeholders and the regulator at both the national and international levels to share information on the effective ways to enhance retirement income security. Thank you for your attention. This is the CEO's address. Thank you very much, Jeff. Thank you very much, Mr. Chairman Eric Appiah. Thank you all.
Thank you very much, Mr. Amartey Vondi. We are grateful that you make time to speak to us. Very grateful. So Eric, your suggestion has been taken. We are going to do about 5 minutes after party, but that will be after we have said the closing prayer. We'll come back to have a conversation for just about 5 minutes for those who are still going to be around. If that is fine by everybody, I think we will do that. So like we did yesterday, after the closing prayer, our panelists would kindly, I would ask you to activate your camera. We'll take a screenshot picture, and then we'll start the after-party conversation from there. On that note, I'd like to invite Ernest Atima to pray with us and end us with a prayer.
All right, shall we pray? Father in heaven, we are most grateful for today. We thank you for seeing us through these events from yesterday through to today. We thank you for the knowledge and insight that have been gained on these events. We pray in the name of Jesus that may it be used to further this economy. We pray committing every one of us into your hands, that may you continue to keep us safe and deliver us from everything that is evil. May our various businesses and endeavors prosper. In Jesus' name, amen.
Amen, and thank you very much. Thank you to all of you. I'll ask our panelists to kindly activate your cameras so we can take a group photo, and then afterwards we will take the rest of the questions if anybody has it. So our dear panelists, please activate your cameras. Thank you very much. And I would ask my team to take a snapshot and let me know. Mr. Vondi, you can equally activate your camera as well so that we have you in our shot too. Thank you very much. Pakofi and Carl, if you are available, please feel free to also activate your camera. Okay, thank you very much, all of you. So, like we said, we would have the next 5 minutes to have some sort of a catch-up or conversation for those of us who still are available to have this conversation. I'm going to leave it to Eric and to Pakofi so that for the next 5 minutes we can jojo a bit more on anybody who may have a question. So, Eric, do you want to take up anything?
Yeah, sure. No, and maybe the after party was maybe my own selfish way of trying to get more information from people like Isaac about their portfolio management strategy, so I can sort of beat them in the rankings because they're doing very well. But no, so Mirabel, great presentation. One of the things I wanted to find out, do you find it easy to raise capital, let's say, when you go abroad versus locally? What are the key differences in how investors perceive the work that you do locally versus international? Oh, Mirabel's gone. Oh, she was there a second ago. Anyway, no, then maybe quickly, I'll just ask you the question, but not that specific question. With regards to MBS generally, and maybe in your conversations with the banks, how receptive are they to the ideas that you've sort of discussed with them compared to, let's say, clearly on the pension fund side, we know people have invested in MBS, but from your side, in terms of the interaction, how willing are they to get involved in that?
Yeah, I mean, our experience has been that they have been very willing. The treasurers have been looking at it as a way to free up their balance sheets. So they're very, very keen. I think for us, the challenge now, we're building the technology solution. We're going to the bank and the Ministry of Finance and the SEC for a license. Everyone just kind of wants to see whether the regulators will accept the model that we've put forward or what changes they will ask for in order to make it robust enough to get the license. So we think that once the license is in place, everybody's going to want to be involved. The feedback we've had from the multiple meetings I've had with all the treasurers is that this is a great way to free up some balance sheet.
Sure, thanks. And Carl, sorry, another under the bus moment, but generally, I think the BOG has come out quite strongly on payment systems, and now we're seeing more conversation around crowdfunding. How do you think that plays out for us in the pension fund space, given that that space is really growing? You look at things like Paystack in Nigeria, the valuations at which they're trading. It sort of makes sense that space is regulated, but how do you think the approach currently works for us in, let's say, the pension fund industry? So, Carl.
Yeah, thanks, Eric. Like you rightfully said, security for us is key because of the nature of the business that we do. So what we hope that will transpire is a lot more consultation from other jurisdictions that are more advanced and have more experience in that space, and so we can obviously get some insights from the lessons learned, and to shorten our learning curve, and all in it with the aim of ensuring that security around the assets that we deploy are maximized to the most to the best of our ability. So at the end of the day, when our clients decide, or when they turn to retirement, the funds are indeed available and have grown in a healthy way. So for us, it's learning from other jurisdictions so that we can shorten the learning curve for us in this part of the market.
Sorry, yeah, and Ike Wama, that is, just a quick one. So in terms of, a lot of investors have generally spoken about Eurobonds and the fact that it gives them a hedge against the currency in times of stress, etc. How do you think that Eurobond plays out in the long term for portfolio managers? Is it something that we should be looking to add to our portfolios going forward, or you think that we should probably play in the shorter end of the curve, just as we do in the domestic market?
Eurobonds are issued by government of Ghana. The same government of Ghana issues local CD papers. So based on your own valuation perspective, I believe you can pivot between the Eurobonds and the CD bonds, depending on what you see on the markets, depending on where you see the market being rich or being otherwise. So if government has given you the alternatives, I mean, why shun and say you stick to one? I believe you should be able to play the market, both market, because that's what our competitors outside the country also do. They play local if local makes sense. They play hard currency if hard currency makes sense. So it's part of the game. As I always say, the music is playing. You better dance to it.
And KB, a question for you. And again, I know nobody has any idea what I'm going to ask, but in terms of like when you look at the market overall, are there any particular investments that you see or investment classes that you feel like if they came to market, it's something that you would do, and maybe not something we've necessarily discussed, but that you see the opportunity, but just nobody has actually paid attention to that? Are there any of those types of things you see from where you sit?
Yes, Eric, and even in the alternative space that we're talking about, I mean, we talked about, apart from private equity that has come out clearly, in the new guidelines, there's provision for REITs, there's provision for private debt as well. There's even provision for project financing. All these are interesting things that, if they are available on the market, will enhance the portfolios of pension schemes, as well as provide some further diversification. I think ultimately it's the quality of these issues and the availability that is not working for pension schemes.
Sure. Okay, and also just a quick one, and having the benefit of having worked outside, how do you see our capital markets development in the current stage in which we are versus, let's say, clearly Europe, where you worked a lot? Are we there yet, or there's quite a lot more to do?
So we're nowhere.
Before you continue, Eric, I'm sorry. So there was a question I meant to direct to Kweku, so maybe you can add this to the response as well. Yeah, I'm not sure if yesterday you mentioned something about 55,000, but there's a question that's saying that an average mortgage at 55,000, is that an indication of the average cost of a home, given your projection for 2013, 2014?
Yeah, so that was the average cost of a home, actually. So the numbers, what they do is they look at the analysis of how many Ghanaians could afford a mortgage, and they say, okay, what would be the typical mortgage that they would need, and the typical cost of a home would be. At the time it was 55,000. Today, in Kumasi, the average cost of a home is near $60,000. Kofuriro is near $40,000. So 55 to 60,000 is an average cost of a home today, is still about right. I mean, Accra has been obviously pushing up the average number, but I think the average is still just under 60. So that's my answer to that. In terms of my answer to Eric's question about the development of our markets and where we are, the simple fact is, we've come a long way in a very short period of time. If you think about the people who've entered the marketplace, the individuals, even DataBank, and look at how far they've come in a very short period of time. And what's happening is that there's an exponential increase in the number of participants coming into the marketplace. So a lot of, I call them Ghana UK. So all of our diaspora kids in finance in the UK are starting to realize that, there are opportunities here the arbitrage opportunities here are insane if people start to really look at where the real opportunities are, right? I'll give you an example. If you take just mango farming as an example, the global price for mangoes per kilo is about $1.95. In Ghana, if you grow mangoes, you're selling them for about 25 cents. Sometimes when all the mangoes come to the marketplace at the same time, you're selling them for 5 cents or nothing. They're just spoiling. We don't have any processing capacity apart from processing capacity that's generally owned by outside investors. So people like HPW, Company Fruitier, Golden Exotics, and Blue Skies. And someone like HPW came into Ghana in 2011, right? So you're looking at alternative investment opportunities, right? You guys are looking at that. So HPW comes into Ghana 2011. In 2011, produces 250 tons of dried fruit. By 2016, literally 5 years later, is building a 3,500 square meter facility for processing fruit and cut fruit. By 2020, last year, has produced 2,500 tons of dried fruit. If you're selling that dried fruit for around $10 a kilo, you could do the math yourself. They've gone from about $2.5 million of revenue to $25 million of revenue in literally 9 or 10 years. There are many opportunities like that on the ground that are way below where we need to be in terms of capital markets. So in terms of development, even the ability of capital markets to see that opportunity is not there. If you look at capital markets themselves and the products that are available, there are countless products that we need to put in place. Obviously my old wheelhouse ETFs are, again, I tend to look in terms of macro-prudential tools. In an age of financial repression, if we don't have tools that allow our central banks to channel assets to where they need to channel it in the same way that Western central banks and legislations are doing, then we are basically hampering ourselves. And it's these products that allow us to do it. So ETFs, for example, simple passive benchmarks that allow us to direct capital into certain areas are not available. And of course, that's why often our pension funds are struggling and giving their money to the government, because where else do you put them? And it's very hard to find those opportunities where someone on the ground will go, here's of an opportunity to go from 250 tons of dried fruit to 2,500 per year. And it's that's kind of where our Eric, we've spent a bit of time together, and I've seen people come to you looking for opportunities for investment, right? Because they've had an idea, and you have capital that they want to leverage. We need to see more and more of that, and that's kind of this private equity space where people are being very dynamic and looking for individual opportunities where they can really scale up and really like increase the capacity of the people on the ground who don't like Dragon's Den style. The private equity guys are really, from what we've seen today, like Mirabel said, what they're really doing is really increasing the capacity of people on the ground. And for me, that's where the economy needs to be right now. That's where our assets need, the products that we have need to be dynamic enough to go in search of these opportunities. So whilst the same products that are in the West do not currently exist, products like ETFs, broad options, etc., which would lead to liquidity in the financial markets, though not necessarily to gains in the economy generally. It could be said that if you guys are to focus on finding ways to systematically direct cash to these types of opportunities on the ground, where, for example, smallholder farmers will be able to find ways to sell their mangoes not for 25 cents but for $2 a kilo, then you're really contributing to the economy, because you're pulling up especially young people from the ground who are going to be doing this work. I think it's normally we go, okay, let's focus on the products that exist in the development market and let's see how we can implement them here. That is the case for low-hanging fruit, but I warn against that because it's an economy that requires a lot of dynamism, and I think that we have the ability to direct cash to projects where they're needed.
No, thanks. That's great. I was actually going to ask you a question about ETFs, but I think you sort of answered it, given that you're quite familiar with ETFs. In terms of, we do have a gold ETF. Not probably well patronized, but are there any other ETFs that you see that gives us exposure to other markets that you think makes sense for our markets?
Well, I certainly think that there should be an ETF on the benchmark of Ghanaian government paper, right? There should be an ETF that gives you exposure to the full benchmark. And again, the reason I say this is not because I think that people are too lazy to pick out the right what they really want in terms of exposure, but because you need a macro-prudential tool, right? You need an ability to slow down or speed up the allocation of capital to government paper. So I think that's something that needs to be created because it teaches people a culture of how this asset works. Same thing needs to be said for gold. Although again, you have to be careful to make sure that you're not creating paper tracking gold, but you actually have physical gold sitting somewhere. Again, it's all about being able to direct resources to where it's required. If lots of money is moving to gold ETFs, then gold manufacturers start to see that they can produce more gold, right? They themselves can sell the gold into the ETF, and so it's kind of how do you push prices? How do you push performance in different areas of the economy where you need to target performance? And that's why you need ETFs, not because insurance funds need, you guys have the ability to allocate, pension funds have the ability to allocate if they really want to at a very, 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 in a very, very dynamic way. If they want to, they go to private equity who will go direct to an individual company. So, the long and the short of it is the other ETFs that need to be created. Having said all of that, the other ETF that needs to be created are sector ETFs that target, for example, the financials or the telcos and any other technology companies that are there. Certainly, there needs to be a broad-based ETF that tracks the Ghana equity market, because then that allows pension funds, again, it's all about targeted resource. It allows the pension funds to have an asset that they can target assets to, which then pushes prices higher, which then leads to more investment, which then leads to the growth of our corporates. The one thing that's really sad about Ghana right now is that if you look at our equity markets, the participants in those markets are actually really great companies, but we just don't have a culture of directing capital to them, right? And if we start to think about investment in a different way, which is that we need to direct capital rather than we need to seek returns, right? If we're looking at how, because everyone here has been talking about how we need to improve our economy, and we hope and we pray that everything we're doing does contribute to the bottom line in our economy. Well, then we need to think about how we allocate resources rather than the returns that we get, in which case you need ETFs that can send capital into the equity markets to push up prices, which then attracts investment, right? It's really technical. It's not really about returns, unfortunately.
Yeah, no, look, that's some great insights there, and I really appreciate that. Courage, I have a question for you, and if you don't mind, I'm going to nickname you Greenspan. So Courage Greenspan Mate. Great question. In terms of the regulatory environment, and just as Kweku was talking about, the regulatory environment, super important for all the things that we want to do. Do you feel there's that coordination there currently between, let's say, BOG being the regulator of banks, the Apex Bank, the NIC, the SEC? Is maybe, oh, Vondi is on. Maybe I should have asked him, but I would ask you first, and then maybe Vondi can give us the insights as to how they coordinate with the other agencies.
Well, yeah, very good question. Before now, I would have said I don't see that coordination properly, but now I'm beginning to see greater coordination amongst the various regulators. And this coordination is coming on the back of the just ended IMF program, which introduced a lot of reforms. And you recall some of the reforms included the establishment of the Fiscal Council, but also the establishment of the Financial Stability Council. Now, under the Financial Stability Council, they brought together a whole lot of regulators in the financial market. So now you have the Bank of Ghana, the SEC, the NPRA, and other financial intelligence centers working together to be able to coordinate activities within the financial sector. Because one of the reasons why we saw a bust in the financial sector and necessitated the reforms was that there were operations that went beyond the remit of the Bank of Ghana. And the Bank of Ghana could not extend beyond its jurisdiction. And so certain operations looked like deposit mobilization, for instance, and that would have fallen under the jurisdiction of the Bank of Ghana. But when you go beyond that, there are operations beyond that went outside of the jurisdiction of the Bank of Ghana. And the Bank of Ghana could not push beyond its boundary. The other regulators could also not do much because they didn't have enough information about the company. So now the financial sector or the Financial Stability Council brings together all these regulators for information sharing, and then they are able to work together. And so very quickly, you can get the SEC collecting information from the Bank of Ghana. You can also get the Bank of Ghana sharing information with the NPRA. And that coordination has been increased or strengthened. And going forward, I think we'll start to see better coordination of reforms when they come out. And that actually came out from the reforms that were implemented during the period of the 2017 to 2019 financial sector reform. So I am hopeful that in the past, it wasn't a pleasant story, and that's why we had a lot of distress in the sector. But given the lessons learned and the reforms implemented, there should be better coordination on the back of the Financial Stability Council established going forward.
Thanks. And Mr. Vondi, from your perspective at the NPRA, how is that coordination going with the FSC?
Maybe whilst we wait for Mr. Vondi to activate, I'm just told that our webinar room ends at 1:30. So
okay,
in about 5 minutes.
Yeah. Okay. I mean, if he doesn't answer, look, let's open up for anybody who wants to ask a question. I think I've exhausted all the questions I wanted to ask.
Sure.
So if there's anybody on who wants to fire away, please maybe switch on your camera and ask. Might be quicker.
I think participants cannot activate their cameras or microphones, so they can only type out.
Okay.
Yeah. But maybe because Kweku is still here, there's a question for you. I think it came in from yesterday. You can respond to it. It says to Mr. Adoboli, it does appear to me that the primary mortgage market cannot properly function without a secondary mortgage market. So why haven't we focused on the secondary mortgage market, etc., on this?
Sorry, let me just change my sound source. Yeah, so we, this is designed to facilitate and incentivize the secondary market. We know that without a secondary market, the primary market is kind of moot. And the idea is that by freeing up banks' balance sheets, they're able to make new loans. Now, of course, if someone buys a home, and it doesn't matter to them whether the bank gives them new money, and so there's no apparent direct correlation between creating a mortgage-backed marketplace and the people and the trading of second homes or the secondary trading of homes. But we believe that what will happen as a result of funds being made available to people is that the elder, so the elder patriarch or matriarch in the family who has access to the capital locked up in their home will now have a way in which to assist the younger generations to move out of their home, right? So, again, it's like, well, you have a house, your house is worth $500,000, let's say, sitting in East Legon somewhere, you can't liquidate any of it. But what you can do is you can go to the bank and get a mortgage for $50,000 based on a fraction of your home, and then give that $50,000 to your child. Or you could say to your child, okay, you go, get a new loan and we'll use this existing mortgage or this existing home as the collateral for that cash. There's lots of different ways to do it, but the point is that just by creating a mechanism for refinancing, you are then incentivizing the banks to find mechanisms to make more loans. And the point is that this is not demand driven in the same way that you think. A lot of questions have been asked about the culture of Ghanaians, the culture towards debt. The culture of anything is driven by the situation, the context of the environment that the people operate in. The fact is that there has been no opportunity, no mechanism truly to provide primary or secondary mortgages. And therefore, there has not been a culture that has evolved that allows people to think about owning their own homes. As soon as you provide that opportunity, suddenly 18, 25, 30-year-olds who are still living at home will be able to have a conversation with their parents and say, maybe it might be better for me if I move out. Can we talk about a way in which we can, or they can say to their parents, can I have help? Can I have help to move out? And their parents will be able to say, oh, well, maybe we can get a mortgage against our home. So we think that all of the things, all of the classic reasons that people give for the lack of homes, when you boil it all down, it's because the opportunity to raise the capital is not there. So if you fix that, then hopefully the culture will change.
Great. So thank you very much. Eric, I don't know if you have any last words.
I had one last one, but I know we have 2 minutes, and I would love for Free to say something, but just one last one, and this is to Mr. Greenspan. I know we've talked about Ghana, we've talked about how bad things are, but if Courage could just give us a sense of where Ghana is in the context of Africa, like, are we doing worse than everybody? Are we doing okay, or are we doing better? Like, where are we? And that's my last question, Jeff, I promise.
Well, it depends on the indicator you're looking at. I mean, generally, I think we are doing very well when it comes to regulation, when it comes to commitments to reforms. We are doing quite well, and every now and then we seem to see commitment from the regulators and the managers of the economy to certain credibility. I mean, when it comes to macroeconomic framework, we seem to have a very robust macroeconomic framework right now, and it has placed the economy in a very solid position. The reforms we did in the financial sector prepared us unconsciously for what came last year. And the reforms we've also made in the fiscal sector also has prepared us very well. When you look at the shocks and how the economy absorbed the shocks, you say we did it better than a lot of our peers. When you consider the South Africans, the Nigerians, the Kenyans, you see that we've done quite well. But then there's still room for massive improvement. And so we cannot rest on our achievements. So we still need to keep going in terms of improvement.
All right, thank you very much to you, Courage. Thank you very much, Kweku. Thank you very much to all our panelists, our NPRA representatives, everybody. We are very, very grateful. We do have a list of all participants in terms of your contacts. So we are going to share with you a link to all the presentations and all the details that we have shared here in this conference. We are very happy and excited that you join us this time around, and we hope that next year you will make time to join us again. Thank you very much from all of us here in Access, as well as our colleagues at the CFA Ghana. Thank you. Cheers.
Thank you.
Thank you for a brilliant conference.